screen okay?
Yeah, you're good to go.
Awesome. All right. So appreciate you guys all joining. I appreciate this opportunity. I'm pretty excited about this. Um, being joining Josh's Discord has been a game changer for me. Learning from a lot of people on here, Mary, Eritwan, Spy Lord's been great. One of the things that Mary and I were connected on and were talking about was there's a lot of people that are trying different strategies. Like we heard of meat trying to, struggling with scalping, and is there other ways to do stuff? And there are so many different ways to create income in every different types of markets. Some of my three favorite ways to do it, and this is basically the order that I learned them in, were covered calls, cash secured puts, and bull put spreads. These are all credit options, right? Where you get paid to do that instead of what Josh is doing a lot of the scalping. You got to buy the option, right? And then you get time decay and things like that on there. Some of these don't have time decay. Some of these can be just as profitable. And it all depends on what your trading style is. If you can't sit and manage it in a trade minute to minute, and watch it all the times, these might be some other options for you guys, pun intended, for you guys to try out in your trading strategies. And it's always good to have multiple trading strategies because, the market right now is so volatile, right? You can buy your options and see them disappear in seconds, if not minutes. So these are some of the ones that I've learned over the years, and I hope these can help you guys out. So I'll go over to each section, stop in between each section, answer any questions, and then we'll move on. All right, so let me get my mouse over here. Here we go. So cover calls. It's not letting me go page down. It's not letting me page down. All right, I'll just have to scroll down. All right, so what is a cover call? A cover call is when you actually own the stock, and then you sell a call on that stock to create a premium. So it's a pretty simple strategy. If you own Apple, you've got 100 shares of Apple, and Apple will pay the options traders will pay you say $1 to sell that call. You make $100, right? To sell that call, and you set an expiration date, and everything works out great. You collect the premium and keep your stocks. All right, so what is a cover call? It's a strategy consists of two instruments, a long stock and a short call. Like I said, you own the stock and you do a short call on it. It can be used to generate periodic income. You use the short call proactively, can take your net cost, that should be your net cost basis to zero over time. So what does that mean? If you keep doing this month after month, year after year, right, and you generate a ton of revenue on it, that could actually say, hey, I actually own that stock for free now. I know Eritwan talks about it all the time on I think it's MSTY, right? He talks about he sold so many calls in it, he almost owns the stock for free now. Strategy is very flexible, right? There's a lot of different strike prices, strike dates expiration dates you can use. It's easy to move it around and manage it. The two exits are primary and secondary that we'll talk about, and it works nicely when applied to dividend stocks. If you've not heard the term the wheel, learn it. If you own dividend stocks, the wheel is your best friend. When you get the dividends, you sell calls, and you just keep spinning the wheel on it. It just keeps going back and forth, and you buy more shares. Great way to increase your portfolio. All right. Um, Again, we talked about the long stock. We own the stock, right? Some of the things that we're going to do, we're going to sell the open up here. The short call, now you got to be aware, the short call may obligate you to sell the stock, right? That means if you sell Apple, and I'm just going to use random numbers, not today's numbers, right? Apple's trading at, $100, and you sell a call for say 110, and it expires in 30 days. And Apple shoots up over that $110. If you don't close that option by the time your expiration date comes, you will get a sign, which means you will lose Apple, but you made profit. You made the call money, and you made the money, whatever the difference between what you bought it for and what you sold it for. So as long as you're okay with that, cover calls are great. Risk is covered by the equity ownership. Again, you're not going to get any margin calls. You're not losing any time, right? Time decay on it because you own it. The strike placement of the short call affects the potential reward and probability of reaching it. So if you do, and I'll go over this because there's different types of short calls you can do on a weekly, monthly, and longer. It's a bullish or stagnant or slightly bearish trend, right? So it's kind of confusing. You're saying, wait, if it's bullish, stagnant, or slightly bearish, it all depends on where you set your strike price. Net cost basis, the equity purchase price, what you pay for the stock, plus the short call premiums. That's how you make your money. And the maximum potential reward is the short call strike price minus the net cost basis. So your short call minus how much you paid for the stock. Again, long equity, short call. Primary exit is two choices. You can have the short call assigned, right, where the options expire within short call in the money, or you can have prior to expiration as early assignment. And this has happened to me. So what that means is I owned well, Tesla's happened to me more than once. I like to buy Tesla, and for obvious reasons. And a couple of years ago, Tesla, when it won during one of their splits, I sold a short call on it, and Tesla exploded within the time of the short call, and I got assigned early, like 4 days before my call was to expire. I got assigned to it, but I was up, so I was okay with that. And of course, the Tesla came back down later on, did another split, and I bought back in. So I was fine with that. But you got to be aware of that. The short call expires worthless. The short call must be out of the money at expiration. That is your ultimate goal, right? You get to the expiration date, it's worthless. You collect your premium, you keep your stock. Those are your two primary exits. Your secondary exit, if the primary exit is to be assigned, then there's only one bad trend, that's bearish. So that means if the primary exit is to be assigned, that means you're moving in a bearish thing. It's moving against you. If your intentions were for the short call to expire worthless, then you must also be prepared for a bullish trend. Like I just said, you got to be prepared for the bullish trend, and there are some things you can do to counteract that if you want to keep the stock. Strike price. What strike price do you choose? Okay. You have to make sure your strike price, if you intend on keeping that stock, you want to do out of the money strike prices, right? If you are okay with losing the stock and you're just trying to collect the maximum amount of premium and you'll gamble, hey, I can lose it or not, but I'm not going to lose it at a profit, you can do an at the money strike price. There's a lot of people that do that and they do it very well. And you can also do an in the money strike price. So in the money is only if you think that stock is going to go south. If it's bearish, you're going to sell it. In the money, it's the highest amount of premium you'll get, but it's also the biggest threat for you to get called away. And if you do get called away, you could actually lose that money, lose whatever value you had in that stock minus the premium. So you got to weigh the balance on that. Which one should you choose? Like I said, if you want to keep it, you want to do the out of the money stock, the money strike prices. If you're okay with getting it assigned, but you want to get a good premium on it, but you're basically just trying to do a cover call swing, then you can do an at the money. If you believe that is going to take a dive, right? Right now in the monies, the past couple of weeks, in the monies would have been paying you big money. If you're okay with that and you learn how to actually adjust those down the road, you can do an in the money strike price. All right. So there's basic three types of option expiration choices. You can do a weekly. A weekly will give you a smaller premium, but you can sell more during the year. I do that on a few stocks, and they're volatile stocks, right? Example is one of them is BITO, right? It's an ETF that tracks Bitcoin. I do that weekly. I sell that every week and collect premiums on it. There's a few other ones you can do that with. Has greater potential for cumulative value, which means it just keeps adding up, adding up, adding up. And if you want, you can go back and if the stock is taking is going down during that time, you can just reinvest those options that you're getting the premiums you're going and buy it in DCA down as it goes down also. They are harder to manage, which means if that stock takes a big jump during that week that you have that option on it, you've got to learn how to roll it out. And so the thing with rolling out is your prices may not always be there depending on what you did. You may have to push it out more than a week, a couple of months sometimes just to get back above that current stock price. So it does make it a little harder to manage. Monthly premiums are by far the most popular, right? That the third Friday of every month, more premium, but you also get fewer sold per year. But they're also probably the more safer ones. Long-term options, you can do far, far out. Tesla's another example. I did a Tesla um, a few months ago because I got caught up with the when Tesla took off and it blew past my my strike price. I pushed it out 2 years, collected a huge premium, and then I've been back pulling it back slowly, slowly, slowly as Tesla came back. So there are things you can do to manage those, but long term does need the least amount of attention unless that stock does take off. Biggest thing when you're doing your expiration choices is watch for earning dates. And I can't tell you, earning dates can ruin your cover call very quickly. I try and keep my cover calls though at least a week before the earnings date. Sometimes it's not possible if that stock does not have a weekly one, and if it doesn't, depending on what your charting tells you, your technicals, I may or may not open a position and I may just let it go for that 1 month and not take a position on it. Again, it all depends. If you're willing to let it go and you get a good premium and you say, hey, I'll just buy back in later, or I don't, I'm not in love with this stock, that's fine also. Earnings can really help you out. Selecting your options. So we talked about this already, right? Out of the money calls. What I look for is a delta of 8. Right? So that's it means it's an 80% chance or greater you'll keep the stock at expiration and collect the premium. So I always look for deltas of 8. If it's not in that 8 range, I don't take it. And again, if there's nothing really good there, I may just let it pass. If the premium is small, if it's only a couple bucks, sometimes I'm thinking that's not really worth it for me to put that stock out there and have the chance it takes away. So sometimes I'll just skip it also. Bollinger Bands are great. Bollinger Bands, when you look at the Bollinger Bands, if the price is near the upper band, it can be considered overbought, potentially into a price correction. So if it's all the way at the top, at the ball, when you're ready to do that, you may want to keep moving your strike price above that, right? Because you don't want to get caught getting taken away if that's not your primary goal. If the price is near the lower band, it can be considered oversold, potentially into a price increase. So again, you got to watch those also. But when you want something, if it's in the middle of the Bollinger Bands, that's usually the sweet spot. And then you look at that upper band as maybe where you want to place that cover call. What's the benefits of a cover call? Income generation, right? It is one of the easiest ways to generate income. Doesn't require a lot of management on your part. And again, you can just take those. I most of mine I reinvest. I go back in every time I sell a premium. I go back in and buy whatever that premium got me. I buy more of that stock. It does have limited upside, right? So again, if your stock goes up and it blows past your cover call and it gets taken away, you can't take advantage of that increased rise in the stock price. So it does have that limited upside. That should have been under risk. I don't know how I got under the benefits. Sorry. Risk, missed upside, which I just talked about, right? So you can't take advantage of that. The other thing too is on a risk too is be aware if you got a cover call and that stock starts to drop, you cannot also set a stop loss either, right? You have to buy back your covered call before you can set a stop loss. That is not a position where you can do one cancels the other. And there is an obligation to sell. If it's exercised, you're going to have to sell it. It will get taken away at expiration date if you haven't closed it out. So that's an out of the money. At the money, again, if the stock stays below the strike price, call option expires worthless. Beautiful. You keep the premium and you receive for selling the call and you keep your stock. If it rises, you're going to get exercised. There's no doubt about that. It automatically will generate. And they'll take it from you. Again, income generation is what your goal here. Again, you can supplement if it's a dividend stock or other income from the stock. Great. Potential for downside, again, if it remains flat or decreases, the premium can receive an offset for some potential losses, right? So again, if the stock starts to dip, but you're still getting premiums for selling the cover calls and you're buying back in and DCAing, even if you're not buying back in, if you're just taking that cash and reinvesting it somewhere or building up your gunpowder supply, beautiful, that's perfect. And you're looking for neutral or bullish strategies, right? On the at the money. You don't want to have something that's really, you see that the stock is going to take off because it's going to get taken away from you. You want something that's neutral to bullish for at the money. Limited risk, again, it's maximum loss is the purchase price of the stock minus the premium. In the money works well in a bearish market. It only works well in a bearish market, to be honest with you. Um, the stock price is higher than the call option strike price. The option is considered in the money. It's going to go. You're going to be obligated to sell. Has very limited upside. Again, if it gets called away at that number, you don't get advantage of the stock rising in price. Potential impact of assignment, same as the other ones, right? Missed upside and the forced sale. All right. What happens when your covered call starts to get into your strike price or in that range or above it? You can let it go if you want. That's fine. If you want to keep it, you can go ahead and roll the call. You capture more premium. You protect against the losses. You extend the position by week, month, whatever it takes to get you to where you want to be. There's certain things you can do. You can roll up and out. It's a combination of rolling up on the strike price, rolling it out by date. You buy back the existing call, sell a new one with a higher strike price and later expiration. Rolling a call, when to roll as the stock prices increases, like I was just talking about, right? If it increases and you want to keep it, you can roll it out easy. Again, you've got to watch your dates and your expirations, right? You don't want to probably run into, and make the mistake of watching it and roll out into a earnings date either. So watch those. Rolling strategies, rolling up, rolling out, just talked about it. There are other strategies you can do with doing a cover call. I don't recommend a lot of them where you can manipulate your cover call to roll down if say your stock is going down. Again, I use Tesla as a great example. I've been rolling back, right? I've been bringing it back in closer. I'm back into this year, but I'm at a lower price, which is just fine, right? If that's your goal, right? I can move Tesla back and forth around because it has great options to do that. Not every stock has that ability to do that. Closing your position. One of the things you want to do when you get near your expiration date, and if you're closing in on that strike price and you want to keep that stock, close it. Take whatever profit you made and close it out. Just say, hey, I'm good here, right? If you don't want to take attention assignment. I've personally have seen sometimes I'm like, oh, I'm good, right? I'm within 50 cents. It's not going to go. And then Saturday morning, I get an email from E-Trade saying, oh, you sold this because at at quarter to three on an, well, I'm sorry, I'm Central, quarter to four at East Coast, right? Market time. All of a sudden there was a run on the stock market. We've all seen it, right? And now my option went up above my stock went up above my cover call option, and I ended up losing the stock because I wasn't paying attention. I was paying it too close. So you might want to take that last minute surge can take it away from you, and it has happened to me a few times because either wasn't paying attention or didn't close it out the day before like I should have. All right, so that's cover calls in a nutshell. I didn't want to go through every single scenario, but if you guys got some questions, we'll take them now before we move on to cash secure reports.
Well, thank you, Tom. Before any questions, first of all, for covered calls, you have to own 100 shares of that stocks before you practice covered calls, okay? So one contract represents 100 shares. So to those people who doesn't know what's a covered calls, you have to own the shares to exercise this and to be able to receive that premium. If you don't have 100 shares of that stocks, you will not be able to get a covered calls. Okay, just to
Good
clarify
point.
that. Mhm. And
The funny thing is,
also,
I have it in the next two things. I forgot to put it in the cover call one.
no worries, no worries. And also, covered calls is a very less risky. You basically don't lose money, right, Tom? The reason is
You
because
don't
it's
lose
either
money.
two
You
things.
don't. So that's a tricky question, right? You don't lose money on a cover call if you're willing to hold on to the stock, right? On the option itself, you won't lose money. Yes.
That's
On
correct.
the stock, of course, if it goes down, right? But the cover call itself is guaranteed money. You get the money.
Yes.
Yep.
And when you have to exercise this because the price went up above your strike price, you have to sell it. Regardless, you are going to win because just like Tom's saying, if Tesla goes 100, if it's $100 and your strike price is 110 and the 345 it hits 111, you have to exercise that regardless, but you still get that $10 profit. So you do you get the premium, Tom, for that? Because I don't do covered calls. So if you have to
Yeah,
exercise
my
your
granddaughter's trying to get in my office. Say it again, Mary. Go
no
ahead.
no worries. So I have a question actually. So if you have to exercise this options because your strike price is 110 and went up to 111. So obviously you have to sell your stocks 100%, and so you get that $10 profit. Do you still get that premium regardless?
Not the premium. The premium is yours. So you get the rise in the price plus
Okay.
the premium. Yep.
Okay, so you get two. See, so you
Yep.
don't lose money regardless, even if you have to
No.
exercise it or not. So that's what I'm trying to say.
Yeah, it,
So
it,
it's
it is a great lazy man strategy for income, to be honest with you.
mhm. And
Did you
what
say you did
and
you
what
say you
Tom was
could cancel that or you can extend it? Is that what I
Yeah,
was
so you can
understanding?
so when you cancel, right, that's buying back your call, right?
Okay.
Again, if you want to keep the stock, you're like, man, I love this stock. I believe it's going to go places. I don't want to. You can buy it back. Now, depending on when you're buying it back and what the stock price is at the time, you may have to pay, right? So say you sold it and you got $100 premium, and now you're going, well, the stock took off. The market adjusters are not going to just let you buy it back for that $100, right? They're going to say, hey, now that option is now worth 150. So you may have to pay that 150, but then when you think, hey, I got 100 already, I'm only paying 50 to keep it, but the stock price is increased by $30 a share, then that's a no-brainer. You'd want to keep it, right? So you can do that. Yeah.
Okay, thank you.
Yep. And I've done that, right? I've done that plenty of times, right? Because you want to take advantage of that huge rise in price, but you got to remember you will pay to buy it back a lot of times. Now, if you want to close it early, right, and it's under your cover call strike price, then the potential for you is you'll have to buy it back, but it'd be less than what you sold it for, right? So you'll still make some premium if you want to close it out. Like I've closed it out and spent like, I got $50, $60 on one contract. And then I look at Thursday night and I'm going, hey, I want to close this out tomorrow because it's getting too close. And you pay, $10 to get it back. I mean, I'm okay with that.
Oh, that's not bad. Okay.
And just to add what Tom had said, he said something like, this will play out well if you are doing a covered calls with a dividend stocks, just because you are also receiving your dividend and your premium. So that's why it becomes a good passive income for everybody. So if you pick all those dividend stocks that saying like Airtwans, he has a pretty good dividend stocks. And I think Eddie had give us a list of good dividend stocks, and these are high paying dividend stocks. And if you try one of them, as a matter of fact, I'm gonna try two. Thank you, Tom. I'm gonna try to do one and see how it goes. Like it's not like I'm selling those dividend stocks anyways, because I'm getting premium every month. But I think I'm gonna do the covered calls and see how I don't do covered calls as well. So that's why I'm also learning. Thank you, Tom.
So that's a great example. Like Airtwan, right? Does it? MSTY is a perfect example, right? I started buying MSTY last year, and it was in the 30s, right? Now what's MSTY? I think the other day it was like 22 or something like that. And you'd be like, wow, I lost $13 per share. Well, I get the dividends. They still pay great dividends, and I sell cover calls in them every month. So I help reduce that loss, that pain I feel that the stock has dropped because of current events. So that's a great strategy, right? When you have dividend accounts to sell these cover calls.
So I have a question. And well, um, because I bought SoFi to do covered calls on, and I think I bought it at 14. I think I mentioned it to Miss Mary the other day. But I know you guys were saying it's good to do the covered calls on that. But I see where the premium is like very low, like there's nothing much on there.
Mhm.
So what would, be a good thing to do, with that right now, since the price of that stock is like,
So I'm
all the way
very familiar with SoFi. I've been in and out of SoFi since it first became public, right? It, and I got interested in it because I'm a Parent Plus loan guy, right? Pay a
down.
lot of money to the government to help pay my kids' education. So when you do that, here's the thing, right? Because SoFi, and I haven't had it in a couple of months, so I don't know where it's at right now. The one danger I do tell people with a cover call is if you are under, right? You're under your cost, right? So let's you said 14 you bought. What is SoFi today?
Let me check.
All the
Or
way down. It's going down even more. And I bought it for that purpose, but I didn't use it because I wasn't sure how to do the covered calls.
yeah,
And so I didn't start,
so
doing covered calls on it as yet.
it's under
Yeah.
your buy price right now.
It's
My average, I was
$9.
trying to average down on it.
Yep.
Let me just look and
It's
see.
$9.57
Okay,
now.
so it's way under. Okay, so your danger here is if you start selling cover calls, and let's just say you're like, hey, the only premium I see that's decent is maybe $11, right?
Mm.
And then of course, all of a sudden you hear all tariffs are off, all tariffs have been settled, right? What's going to happen to the stock market?
Gonna go up.
It's
Price gonna go up.
Mhm.
and it's going to blow. And a company like SoFi, because it's a fintech stock, right? It basically, it's a techie stock, right? And financial, right? And
Financial.
yeah,
Mhm.
so it's got both, right? It's right. It's
Both
in
with
both
Bitcoin too.
verticals. It's going to take off, and it's going to blow through your stock price, and you're going to get called away, and you're going to be going, great, I just sold it $3 less than I bought it for. That's the danger. So sometimes covered calls are not in your best interest, right? If your premiums are not good enough and you're that far under. Now, what you can do is if you find a good price, say a month out, you can figure out if again that's where you want to start figuring out, do I want to roll the stock? If you start looking at the technicals and you're down enough where it's not worth to sell for a couple bucks to have the stock taken away, you might want to wait, right, until things kind of settle down a bit. That would be my advice. I do have some of the stocks right now I don't want to sell cover calls on because there's some like in the past couple of weeks, we're all down, right? Everybody's down across the board. I don't want to take the chance at selling at a 40% loss on some stock that I believe in.
Right.
So right now is tough, right? It's a very tough environment for us to be selling cover calls. Cover calls are great when you're either near the money, you're near your purchase price or above it. When you start dipping below, you can sell it and like you said DCA down, which is a great strategy, but that's when you got to start managing your cover calls when you and adjusting them if need be.
Yeah, because I know, in order to get a little bit of premium on there, you want to put the strike price higher, but then the premium is like nothing, because
Yeah.
yeah.
Like I said, I've got a couple of those right now. You're looking at premiums of like it's like 7 cents. You're like, I'm gonna make
Yes,
$7 to risk this,
$7.
100 shares of this stock. I'm not
exactly.
gonna do it.
But Beth and Tom, there is a purpose why though, because SoFi is only $10 or 11 or $14 that you bought it at that time. You cannot compare this premium compared to Teslas who are
Yeah.
who are more expensive
Yep.
stocks. So if you want to get a lucrative or higher premium, you have to get a higher stocks. So
Right,
that's
I understand. I understand. But I wanted to try, start with that to try it because I've had it and I'm looking at all kinds of videos and I'm still like stagnant. I'm not moving. I'm, trying to get this thing, but I feel like I don't have all the information that I need to get started, to to sell the covered calls because I'm really and so I guess the best thing to do is to get a better stock because if I'm going to use this to generate income, it seems like it's like a slow process. I was just trying to slow process of like generating income. It's not like and I guess that's why people gravitate to the options and stuff like that because you make more money. But then you know
I
I,
think go ahead, Yvette, before I
no,
say.
no, no, I was just saying the comparison, but I
Sure.
know it's less riskier, but I guess it's slower, but it depends on, I guess, the amount of what should I say, money you have to put in it. Yeah.
I think the purpose here, Yvette, is not making money fast, is
Yeah.
generating income slowly but surely.
Yeah.
So if you're going to pick a stocks that you would like to do covered calls, perhaps consider more of a dividend stocks instead of SoFi. I
Yeah.
understand why you pick SoFi because it's less of a cost. It's
Mhm.
affordable. However, you also, if you want to keep this as your covered cost, perhaps consider something a little bit higher so you could get the premium a little bit higher as well. Because like SoFi, $7 for one contract, of course it's little, right? It's very little. But perhaps try like, let's say, like what Tom said, MSTY. That's like
Yeah.
$20. If you have $2,000, that's what it is, right? 2,000, is that correct? Help me with my calculation.
Yeah. Should be like 100.
So
Yeah.
that's a hundred
Mhm.
shares. So I
Mhm.
know you're gonna get a better premium compared to SoFi.
Yeah.
So and just like I said, we want to make money slowly but surely. Our goal
Mhm.
is not to make money fast. Otherwise, we're gonna be greedy. We're gonna be feel anxious. And I think that's not how we make money. And that's how we become ugly because everybody will want that 24-hour success, well, overnight success, right? But we're not gonna get that here. If this seems so easy, everybody will be doing it. And guess what?
Yeah.
No, no. So we have to learn to be patient, and fast is not always good. Consistency is the key to success.
Yep. I think there's a question in the chat too.
Yeah.
Okay, let's cover that. So let's say I own Antonio, you would like go ahead and be on the screen so you could ask questions to Tom. Okay, so Antonio said, so let's say I own 100 of Palantir and my average price is $95. And I do covered call now, the price about $73. And I sell it covered call at $80 in the expiration in 2 weeks. With my price average affect the sell covered call in any way? If you're buying, you want to take over this, Tom?
So he owns 100 shares, right?
Of
He's at $95.
95.
Now the price is 73, right? So like everything, big dip, right?
Yeah.
He wants to sell the cover call at 80, right? Correct. Collect the premium,
Mm-hmm.
set it for 2 weeks out. Will the average price affect the cover call? So your average price won't affect the call, right? The movement in the stock will affect your call, right? So if the stock goes up, then yeah, it could affect your call, right? If it blows through that $80,
You got to sell it.
yeah, that would definitely affect it, right? But your average price is not. So if you take that 80 and maybe buy some more things, you bring your DCA down.
Mm-hmm.
Yeah, that's great. But yeah, if it goes over 80, yeah, you're definitely gonna get called away, especially on a company like Palantir. Um, the funny thing is that I talk about the doing weeklies and monthlies. Companies like Palantir, Tesla, Nvidia, stuff like that. Weekly cover calls in them. I love weekly cover calls in them because if it does say it does go up, you got weeklies you can jump into. If you're on a one that only sells monthlies, you can only move it out by a month and a month and a month. You can do weekly ones and chase the price all the way up, right? And I did that with Nvidia when Nvidia was going up, right? I would sell weeklies and Nvidia would go up, and I'm like, okay, well, it's already past my strike price. So what am I gonna do? I'm just gonna move it out to the next week and slowly chase it up, right? And I got probably 6, 7, 8 weeks out of that before Nvidia started coming back down and came back way down towards my DCA. So you can chase it with a company like Palantir easily with weekly calls.
But Tom, if he sell that covered call for $80 and it triggers his strike
Gone,
price, he lose money.
gone. Yeah,
Yeah, you
yeah,
lose
it's gone.
fifteen
Yeah, it's gone.
dollars. That's a
It's
lot.
gone, and that's why you may if you want to do that, Antonio. I would probably look at doing a weekly one, and then if it goes up, say it's at 78, 79 Thursday, maybe Friday morning, bump out another week and chase it up.
And you could cancel it, right?
Cancel it too. You can get out of it too, right? Yep.
Yep.
But
Mhm.
if it goes above it, yeah, you can move it out to the next week, right? And follow it up.
Yeah.
But yeah, if it gets close, cancel it. Get out of it.
Yeah, you don't
Oh,
have to sell it.
so I have a question on that because that was my concern too. Like, if you have a weekly and then it goes up, at what point do you, if the price goes up, then you can sell it? It won't get called away before, you're able to sell it. How do you prevent that?
Yeah. So if it does go up, and let's go back to SoFi, right? So say you do it $11, and SoFi on Wednesday of that week is at 11:20, 11:25, and you start looking at your charting and you're saying, "Ooh, SoFi is making a move up," right? You may want to get out of that or roll it out to the next week. One of those two options, right? Either roll it out to next week at a higher strike price, which is what I do all the time, because I don't want to give back money. I'm greedy.
Right.
I don't want to give back money. Hey, you know what? Next week, what's next week? What's next week's options? 12, maybe 12.50, right? Because I know SoFi does the half-dollar ones too, right? And you may want to move that out either to a 12 or 12.50, or you say, you know what? I'm not comfortable doing that at all. I just want to buy it back, and I'll buy it back for, I sold it for 7. I got to buy it back for 8. I took $1 loss. But I keep, now I'm moving up with the stock. I'm getting back closer to my DCA. So those are two things you can do with that.
Okay, Harry has the questions. When do we get more premium on covered calls when the price action is going up? Well, your premium remains the same, isn't it, Tom?
So if the stock is going up, right? So great, that's a great question. If the stock is going up, and you haven't sold your call, is that the question? You don't have a call on it right now?
Yeah, he said if he got a premium, I think his question is when do we get more premium on covered calls? Does your
Yeah, I'm
premium
saying,
increases?
when do we get more premium cover calls when the price action is going up? So depends. Have you already sold the call, right? Do you already have a call on it? Or are you looking at a call with a stock that's going up? If you've already sold the call, you're not going to get more premium unless you roll that up, right? You're not going to get, once you sell it, that's it. You collect the premium. Unless you roll that call up or roll it out, you could keep the same strike price and move it out, you collect more premium. If you haven't sold the call, right, and you're looking at the price action, yeah, the trend is usually when the price goes up, you tend to get a little bit more premium. Did
So,
that answer your question, Harry?
I have questions for you, Tom. So, let's say if you have a covered calls, do you favor a market going up or going down?
I want on my cover calls, I want neutral is the best, right? Because
Okay.
then you keep the premium in the stock, or slightly bullish, or even a slightly bearish, right? Where it doesn't come down too far, where it's eating away at your cost average, right? So that's the benefit of cover calls is you've got three different scenarios, right? When you buy an option, what's your only win, right? It's going to go up, right? On a
Mhm.
covered call, you can be neutral, you can be slightly bullish, or you can be slightly bearish, right? And especially if it's a dividend stocks don't move as much as these high price ones. So you got three scenarios where you can collect that premium and keep your stock. The only real, and I don't even consider it bad, is if it gets called away, but it's above your cost average, then getting called away is not a bad thing. You made money.
And you can
So
always cancel your covered calls and you still collect your premium, right? Right, Tom?
If you buy it back, yep, it all depends on what you buy it back for and where the price is at, right? If it's above the cover call, you're gonna end up paying a little more. If it's right below it, you'll pay the difference between what you sold and what you bought it back for.
No, what I'm saying is that you could always sell it anytime before expiration
Oh,
dates,
yeah.
right?
No, no,
Oh,
you
you
get
cannot.
you have to buy it back.
Oh, you have to buy it back. See, that's a
Yeah,
good
you have to
question
buy
because I know.
sell to open, buy to close.
Okay.
you have to buy it
Yeah.
back.
Mhm.
Oh, so you can't just sell it, close it. You have to buy it
No,
back.
Until the
you
Yeah,
already
buy
expiration
it
date.
sold it, right?
back.
You're selling the cover call for a premium. To get it back under your control, you have to buy back that call.
Interesting.
Yep.
So
Thanks.
it's basically like in a weird theory, I guess, in my mind, I see it as like, because since nobody's bought your covered call, it's sitting out there on quote unquote level 2, waiting for somebody to claim it, and that's why you're able to cancel it or move it out or roll it out, I should
Yeah.
say.
Yeah.
Okay.
Yep. And when you think and so my wife used to ask me this too when I first started doing it. She goes, "So there's this people waiting out there to buy it from you?" It's not people, right? It's your institutions. It's your brokers and stuff, right? Your big institutions that are waiting, and it's automatic, right? It's not sitting there going, "Oh, I'm gonna take Tom's cover call on right? It's institutions, right? It's your big players that are just they've got their algorithm set up and say, hey, if you see this, I had an option pulled away from me last week on Microsoft because I did something I did a credit spread and Microsoft tanked and I got it called away, but I'll show you how I adjusted for that. But yeah, it's big players that are taking away, right? It's not somebody sitting there waiting to pull it away from you.
Okay.
It's not Thomas Mullen's stocks. It's his
No,
broker.
no.
Yeah, it's nothing personal.
Um, Lit asks, can I show an example of a cover call using Robinhood? No, I cannot because I do not use Robinhood, and let's not even go into that. Mary and I did talk about this because of time constraints. We'll probably do another class where I can do like examples or even record examples of doing it, and I can show you guys those.
Yeah.
Like do a follow-up class, yeah, Mary?
Yeah, that sounds really
Yeah.
good. So any more questions before we move in? Because
Yes. So since the market is like really tanking right now, is it a good time now to, I guess it would be a good time now to accumulate some stocks that you really feel good about in to sell, covered calls on, because right now your average is going to be good. Like when
Mm.
right.
So this is a group that, right, when everybody's running away from the stock market, right, the regular people are running away from the stock market, we should be running towards it, right?
Right.
Yeah.
Yep.
Okay.
okay, please be advised, we are not a financial advisor.
We have to say
Okay,
that.
so I just would like to confirm that to everybody. This is for educational purposes only. We are not a financial advisors. We are just teaching you guys what we've learned and experienced. Additionally, I forgot what I'm gonna say now. I'll get back with you. I'm so sorry. My son is here. Give me 1 second. I'm so sorry. Go ahead, Tom. Let's go ahead and go to the next class. I'm
So
so
let's
sorry,
move on
guys.
to another strategy, a credit strategy, right? Collecting premiums for selling options, cash secured puts. So a cash secure put, right, differs from a cover calls, right? Because a cover call is you own the stock, right? And you want this to be, like I said, neutral to slightly bullish market, while cash secure puts can be beneficial in a neutral to slightly bearish environment. You sell a put option, right? So everybody's familiar with, trading with Josh, right? Or trading with Spy Lord, right? They're buying, right? They're buying options, whether it's a call or a put, right? A cash secured put is you're selling the option to collect a premium. So essentially, you're agreeing to buy the underlying stock at a specific price, whatever the stock price you have, if the option is exercised. Okay, now one caveat to understand with a cash secured put, and I probably should have put it in here, but it's in the title. You have to have the cash available, right? You cannot sell these, right, if you don't have the cash. So if you're trading in, say, an IRA or something like an investment account, your investment account, whether it's E-Trade or TD America or anyone else you use, right? And IRAs, they do not allow you to do naked puts, right? So you have to have the cash to back it up. So if I wanted to buy or if I wanted to sell 100 shares of Apple, and again, I'm just going to use $100, right? That's $10,000 I have to have available for that, right? So cash secured puts can limit you on what you can do it on based on what you have available in your account, right? They're not going to just let you just do that because you can't do margin in those accounts. If you do have a margin account, I would advise never to do cash secured puts. My next strategy will talk about how to do that. Because if you do a cash secured, do you try it? You can't. First of all, it wouldn't be a cash secured put; it'd be a naked put. And if that goes against you, you're going to wipe out your account, and they're going to do a margin call on you. And everybody's seen those movies like The Big Short and stuff like that. You do not want to be in that, so be aware of that. But when you do have the cash and you want to do a cash secured put, why do you do it? Potential for income. You receive the premium, and the premiums can be very substantial depending on what stock you do. You can buy it at a lower price. If you're okay, if you've got the cash set aside for that and you want to buy it at that price, again, you doing it on Apple and you say, you know what, Apple's at $100 right now. I'm gonna do a cash secured put, collect a $500-600 premium, and at say $85, and then Apple comes down to $85. You would love to buy Apple at $85, right? So $8,500, you've got it. You're willing to spend it. It's $8,500 minus whatever you got for the premium. So if you got a premium, now it's only 8 grand. So it's a great way to get stocks at a cheaper price. And I have done this on less expensive stocks, not the Mag 7 because those things are expensive, but on less expensive stock. In fact, Eveth, I did it on SoFi one time, right? I did it on SoFi and I got SoFi like in the sevens. It was a great price for me. It's a bullish outlook, right? You do cash secured puts when you look at your technicals and you say, hey, this stock is moving up. So that way you collect the premium. If you don't want to own the stock, you do it on a stock that's moving in a bullish direction. And you just collect the premium and you can do it again and again. How it works, you sell the put. You sell the put at a strike price you're comfortable with. When I mean comfortable with, you're comfortable that if it comes back down and hits that strike price, you're comfortable at owning that stock at that price and receive the premium. So you got to have cash set aside, right? You can't, unlike a covered call, when you sell the covered call, you're basically your stock is the collateral, right? You can sell it. You don't have to have any extra cash available to do it. Cash secure put, you have to have the cash in account to buy that underlying stock. Your possible outcomes, right? Your scenarios here are the strike stays above the strike price. Your stock stays above the strike price, excuse me. Option expires worthless. You collect the premium. You're great. If the stock falls below the strike price, the put option is likely to be exercised. You're obligated to buy that stock at that price. Again, if that's your goal, perfect. Important considerations. It's limited upside. Your profit is capped at the premium received, right? So if it expires, that's all you get is the premium. Done. Potential for loss. If that stock drops significantly below the strike price, you could lose money. Again, if you're buying a stock, you're selling a premium at $10 on a stock, and now that stock tanks, like we've all seen everything tank in the past couple of weeks, right? Especially last week, and now that thing's at 6. You get assigned, you own it at 6. So now you're $4 per share in the water, right? Underwater, excuse me. Um, if you're under before the expiration date, right? If that stock drops, you can get assigned early, right? And one of these big institutional investors can have their automatic buy, right? Go ahead and say, yep, thank you, I'll take that, right? You sold it, I'll buy it at 10, and the stock's worth 6, automatically gets assigned to you. So you have to watch that also. Again, and I highlight this in red, only do this if you're comfortable owning the stock. 100 shares per contract, as Mary said earlier, right? All these are you got to have 100 shares per contract on any option that you do. If assigned, here's the good thing. If you do get assigned, you can then use the cover call strategy, right? It's called a collar. A collar strategy. So you get the stock assigned to you, you collect the premium. Now the stock is assigned to you. And say it's assigned at a pretty decent price, right? Maybe $9 and you did it at 10, right? And you got the premium. So you bought it even less than that, right? Now you bought it maybe say 870. And now you're going to go ahead and do a cover call and you go, well, I only ordered for 870. I'm comfortable at doing a cover call at 9. Right? If the stock goes up, gets sold at 9, great. If not, you keep the premium. So you can do a collared strategy on that. All right, moving down. All right, how do you identify stocks that sell puts? So this is something I had to learn personally myself. You cannot be jumping around to every single hot stock that is out there, right? It will drive you insane. You'll never learn from a stock. You'll never understand its trends, right? Whether it's bullish, bearish, right? You've got to narrow your list down to a 10. And this is a really good slide that I got that I learned on something I took years ago. You want to do your fundamental analysis, right? You want to know your earnings release date. You want to know what the 52-week range of that stock is. The debt to equity ratio, right, compared to an industry. Management performance, right? Return on investments, return on equity, right? return on assets, those kind of things. You want to look, and this is a big one right here. You want to look at a stock that has at least 50% owned by institutions. They do not move as much as the ones that are not, right? Your smaller cap stocks. You want to look at something that's owned by 50% institutions. Intrinsic value, right? You want to do your fundamentals on this. You want to do your growth trends as compared to industries. So this was a picture. I actually don't do the 1 million shares a day. I look for a stock that has at least 2 million shares a day, right? Because there's a lot of movement in that stock. So it will be more beneficial to you that has a stock that has a lot of trades, because when it comes to that, it doesn't have as much swings back and forth normally, right? Taking out the current environment, right, in the stock market right now. But normally, when you have a stock that has over 50% institutional ownership and is trading 2 million shares a day on average, those are good stocks to look at to sell puts on. Find 10 of those stocks, right? Identify 10 of those stocks using these I forget what the word I was going to use, but using these
Fundamentals.
bubbles, I would just call it that, right? Using these trends right here. Take that list and start focusing on the 5, right? If it's 5 stocks you know, even better, right? As Warren Buffett says, don't invest in stocks you can't explain, right? In 2 or 3 sentences, right? Take that list. If it's an Apple, you know what Apple does. You know what Microsoft does, right? As examples, right? Small positions to start in each of those trades. Don't be selling 3 or 4 contracts on those, right? Start with 1, right? If this is your first time doing cash secure puts. Don't over leverage by taking too many trades. What I mean is, don't go and say, well, I've got these 10 stocks. I'm going to sell a cash secure put on all of them. Not a great idea. It's not a great idea or anything when you're selling options, right? Don't over leverage. I get to the point. I shared this with Mary the other night, a couple of years ago. I thought I was the greatest trader in the world because it was a bull market, and I was doing like 20 trades at a time. Those get very hard to manage, right? Bring it back 2 or 3 at a time, most when you're first starting out with this. And then paper trade. There's no shame in paper trading, right? Learn the stock movements, learn how to do cash secured puts, or when you're doing selling any of these type of options. Paper trade until you're comfortable doing it. One thing you can do, you can find all of this information on a lot of your
Trading view on the
streaming platform,
fundamental.
TradingView. Market Chameleon is another great one. It has great free filters that you can go and get all of this information off of. I should have put the link in here. Market Chameleon is a great one. You can basically go in and say, hey, show me a stock that has at least 2 million shares a day average. Great. I want to know which ones have 50% ownership. And you can start funneling down this, and it'll let you export it into Excel. Right? It's a limited, it's free, but it lets you get most of these in here, and then you can pull it into an Excel spreadsheet and start looking at what stocks you want to do, right? That's when you start, and then you find those stocks and you start doing your technicals. All right, the strike price. The strike price should be at a price which you're comfortable buying the stock. Slightly below market price, right? Because you want to have the chance that it's going to go up, right? Probability assignment acquiring the stock at a lower price. If that's your goal, then you want to set it close to where you want to be at. Desirable purchase price, the strike price less the premium received, right? I spoke about this earlier. Say you get assigned at 9, right? I'm sorry, your strike price is at 10, and then it hits 10 and you get assigned, but you collected $100 or $200 for it, right? Now your price is $100, $200 less than what the actual stock price is. So you're getting it even a bigger discount. Break even. Hey, figure out what your break even is going to be. And you should learn this on all of it, right? I saw somebody on Discord the other day was confused why he lost money on a trade, even though the stock came down. His break even wasn't where it was supposed to be. Break even calculation of selling cash secure put is a strike price minus the premium received. Again, $10 minus whatever the premium you got is your break even point. So again, $10, your premium was 100, your strike price is $9.90, right? Red days are good days to sell options if your underlying stock is strong based on your technicals and just having a down day. Again, Under normal circumstances, right? Is the market ever normal? No, but when you start looking at it over time and trends, right? You'll notice, hey, I've got a quality stock here. We'll take Nvidia for example, right? It's on a normal strategy day, right? Hey, Nvidia's down a little bit today. This would be a good time to sell a cash secured put on it, right? If you've got the money for it, because Nvidia is going to probably come back up by the time your expiration point hits, and you won't get called away, right? And again, you don't set it. I do not recommend, unless you want to own that stock, setting your strike price at or near the money, right? You want to be under where you're comfortable owning it. Again, I use that delta of 80. 0.8 for all my selling of my options, regardless of what strategy it is. When I'm selling, 0.8 is my target or less. Or higher, excuse me, zero point 0.8 or higher, right? 80% chance that I'll get my money without getting assigned the stock. This strategy does require due diligence, right? You need to know your technical analysis for a good strike price, because if not, you could be in for a huge loss. If that stock, for some reason, goes to zero and you had a $10 purchase price, guess what? You're out. You're assigned, and the stock price is now worthless. So make sure you do this right. All right. Technical analysis. Who talks about technical analysis a lot on this channel? Miss Mary, right? And I have learned a lot from her. And when I say I learned a lot, it's strengthened some of the things that I've used, that I use, right? And brought back some of the things that I had sometimes forgot about using, right? Moving averages. You want to look at your moving averages, right? 180-day, right? We always talk about the 100 and 200-day ones, right? You want to look at the moving average. You want to look for a stock on selling options that's moving in a bullish trend. When I'm selling puts, excuse me, not all options, selling puts. Trend lines. Learn how to draw your trend lines. Learn your historical support, right? That's why I say go back and identify 4 or 5 stocks that you're going to do this on if you're going to do it consistently. Don't be bouncing around between different stocks trying to take advantage of quick trends, right? This is not a quick trend type of strategy. You've got to know your historical supports. Anticipate bullish trends. How do you do that? RSI, 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 right? Make sure the RSI is at a certain level, right? If it's below 30, hey, that's a great chance that that stock is going to likely move back up, right? So you want to learn your RSI. Bollinger Bands, another great way to do it, right? Looking for overbought or oversold conditions to identify potential entry points on that, or strike price, excuse me, on those cash secure puts. And if you're struggling with your technicals, go back, right? Go back to Mary's class on the technicals in the Sunday classes. And I know she said she's going to record a few of them over again, which is great. You're looking for double bottoms, flags, ascending triangles who can signal potential uptrends. There's a few other ones, right? That you can look at. And you want to look at longer term on these, right? You wouldn't be looking for the 1 minute, 2 minutes, 5 minutes, 15 minutes. Those aren't what you're looking for, right? You're looking for daily and weekly on these, right? These action patterns. Strike price selection. Choose a strike price that's slightly above the current price if you don't want to own that stock eventually, right? If you're just looking to collect premiums. Premium calculation. Consider premium receiving to selling the put option. It should be sufficient again to compensate for the risk of being assigned. Time decay. This is where these Greeks, right? And it's all Greek to me. You learn your basic Greeks, right? Your delta, your theta, your gamma, right? Where the movement of the stock takes you as far as delta, right? How it affects that. Time decay with theta, gamma, right? How the movement in stock or gamma will affect the delta. Those are important to learn, and they're not that hard to learn. Once you start looking at them, they'll start clicking in your head what those mean. Because time decay is a big movement on when you're selling puts. Position, don't over leverage again. Don't take huge positions, and don't do too many at one time. Stop loss. This is where stop losses can help you, right? Stop loss to limit your loss. If you're in a position and you're saying, hey, I don't want to own this stock, and I'm seeing I'm already down 20% on this, you might want to consider setting a stop loss and taking your lumps if you don't want to own it at that price. Diversification. Don't go all in on one stock, right? Don't say, hey, I've got, $20,000, right? I'm just going to go push it all forward and go, this is all I got to spend. I'm going to push it all forward and buy, and I sell a contract on Tesla, right? And hope it goes your way. I don't recommend that. Especially if you're starting off this, pick a cheaper stock to start doing this with and learn it. How do you adjust the cash secure put? Similar to what you do on cover calls. You can roll this out, right? Hey, if it's getting close, you're not ready to own it, you can roll it, right? You can roll that put out. You can keep the same strike price if you want to collect more premium, or you can bring that strike price down. Unlike the cover call where you're moving the strike price up, cash secure put you'd want to bring the strike price down if it's getting too close to where you're going to be at. You want to reduce the potential loss for that or extend the time to profitability, right? Hey, I want to move it out a week, 2 weeks, a month, or capture additional premium. Um, Again, an example here, if you sold a put at $50 strike price, you could roll that strike price to $45 if it's getting close out to June, right? Bring it down, extend the time, and maybe capture some more premium. If you're getting close to that option being, to your strike price, you can always buy it back, right? And split the difference on that before expiration. Another thing too, and I got it in the latest slide that I want to emphasize. If you're looking at yours and you sold a put and you're at and say you sold it at $100 and you look 3-4 days later, right? You're like, hey, wait, I'm already up 55-60% on this, right? This is moving great. I personally close those out. I lock in that profit and I say, you know what? That I just made 50%, 55%, 60% in 3 days. I will take that every single time. Close it out, then reopen it. And now set your strike price at a higher level, collect more premium, right? Don't hold it, right? Because that stock could easily turn around if you still got 3 weeks left on that to go. It could turn around and come back down, and then you all of a sudden you're assigned. Lock in profits when you can. Don't hold out for every last dollar. So the rule of thumb on that is if it's 50%, you're in 50% or more profit. And I honestly I like 55 and above. 50% depending on what you charge for your fees, right? Now it's only 49%, whatever, depending how many you did. 55% is usually my number. I automatically I buy it back, lock in my profits. If I still have 50% more time to go, which means if it's a month-long contract and I'm under 2 weeks, right? And I'm at 55% or above, I lock it in. Now, if it goes over that 2 weeks and now I'm pushing 60, 70%, I may take the profits then too and just close it out and reopen a new position. All right.
I had a question.
Yeah, go ahead, Jean-Pierre.
So when you say that you are going to take profit, meaning it's going to go up. So first, when you buy it, you get what you call a premium. So in addition to the premium, that put can still go up.
Mhm.
And, okay,
So
that's
you're
what you're
selling
saying.
these. This is where we're selling it, right? We're
Mhm.
not buying. So we're selling it. So there's no way I can own the stock unless it comes back down and I get assigned, right? You're selling the premium, right? You're
Mhm.
selling the contract. You don't own the stock. You will not own the stock only if it comes down and you get assigned, right? So you're not buying, you're selling on it, right? So if it goes up, that's perfect because now you're just going more and more deeper into profit.
Okay. Yeah,
Make
because
sense?
I thought you want to collect the premium, you cannot get any more money.
No, so you're not, right? You're selling the premium. So what you do is I'll throw it out, right? Apple again, Apple. It's $100, right? You know what? I would like Apple only if it's like 85, but I don't even want Apple right now. I just want to collect the premium. So I sold a put at $85, collect $100, right? Now, we start getting a V-shaped recovery, right? Apple's now 110, 115, 120. I look at my option and I'm at 55, 60%. I'm locking in the profit. I'm taking my money, right? So if it's at 60%, 60% of 100 is $60, right? I'm buying it back for 40. I keep the 60. My profit is $60 now instead of 100 if I let it go all the way. The reason I do that is I can do this multiple times now, right? Instead of waiting it to play out over a month, if I did that every week, if I did $60 every week, $240 compared to 100, a lot more money, right?
Yeah.
So I have a question. You have to actually buy the stock back, right? If you're closing, you have to buy it then. If you're selling the
Correct. Yep.
all right.
Yep. But you're only buying it back because you're in profit, right? You made money.
Right.
I
Yes.
think,
Okay.
again, if you can, like I said, you can move it out, minimize loss. If you don't want to hold the stock, selling can help you minimize your loss. Free up cash, right? So if you're at a loss, you can sell it, take the loss, but free up cash, move it into something else, right? And I've done that too, right? Not every play is going to win. But if you do this smart, you can get a lot of wins and overwhelm any the losses you have if you do it smart. Re-enter the market. Selling the stock, or I should say option. Selling the option allows you to re-enter the market with a new cash secure put strategy if you have a new outlook on the stock, right? Again, and that's in either scenario. I'm in profit. I want to sell it. I'm sorry. I want to buy it back and then collect the premium and come back into the play. Okay, so we're at the end of that. All right, so that's our next strategy. All right, so any questions on cash secure puts?
Yes. So the strike price then is what you have to buy it back at. So you want to go as low as possible.
Again, Eva?
The strike. Okay. In order for you.
Oh, stupid.
So yeah,
Right.
the strike price. So okay. So the stock is at $10, and you're selling the covered puts on it. You want to go to, and so if it gets called away, you want to get it called away at $6 because, or if you have to sell it or buy it back, you want to put it at $6. So that's what you pay for it then.
So on a cash secured put, if you sell a premium on a strike price, right? And again, we'll just use $10 for easy numbers. It's $10, right?
Right.
So you're saying, hey, the stock right now is at $14, $15, right? And you say, hey, I would only want this stock at $10. So I sell a cash secured put, right? I've got the 10 grand sitting on the side, right? Because I'm sorry, it's $1,000 on that one. I got the $1,000 sitting on the side. It's right. It's 100 shares per contract, one contract, $10, $1,000. Great. I'll own it at that. That stock all of a sudden starts coming back down, right? Come back down, come back down, come back down, come back down. Yeah, it's at $10 and you get assigned, right?
Mm-hmm.
You said, okay, I'm fine with that, but you're not buying it at 1,000, right? You're buying it at whatever the 1,000 minus whatever you got for the premium. If it's $50, now you're at 950, so you get it cheaper. If that stock starts coming back even further, right? You get assigned at 10, but that stock really blew past that, right? It tanked. It's at $8 now. Now you own that stock at 8 minus your premium, so maybe 750, right? But you bought it at 10. Now you own it at 750. That is a negative. Yeah, that's a net loss. Was that how you're positioning it?
Yes. And so say the price is at $10 and you say it's coming down, and you have a strike price, say $6. So the further away your strike price is, the less premium. Is that what it is? So you don't bring it down to
Premium, right? Yeah. The closer you are when you place the option, you're going to get the closer the number you are to the actual stock price at that time. You're going to get much more premium, right? So say, yeah, you look at it, you go, hey, you know what? It's $10. I'm going to sell one at 9, but I'm collecting $300, and I'm just throwing a number out, right?
Yeah.
For $10, you're never going to get that, right? But let's say you're going to get $50, right? And you're okay with owning that at 950, that's a great move, right? You just say, hey, I'm comfortable owning it at 950, even a little less, $9. I'm still good. I'm going to get the premium. I'm buying it at a discount because I think that stock is going to take off. That is actually a very good strategy if that's your goal, right? To own the stock at a cheaper price. Yeah, that's a great strategy. If it's not, you want to set it farther down, like you said, $6, right? I don't want to own a stock. I just want to collect premium. right? I just want this to be generating revenue. Then you don't want to set it close to it. You're going to take less premium, yes, but your chances of getting a sign are going to be way less.
Okay.
Again, look at that delta, right? Look at that delta. 0.8, 80%, right? 80% chance you will not get a sign. As that starts moving up, it's 0.9, 0.95. Yeah, you're going to get a higher premium, but you're probably going to get a sign. The chance of getting a sign are greater.
Okay. Thank you.
Yep.
The way I see secured puts is I think this is the best way when you are waiting for the stocks that you want to own. I think this is the best strategy for you guys to acquire that stocks. Let's say Tesla, right? Tesla, how much is Tesla now? 240. Let's say I only going to buy Tesla if it goes to $200, hypothetically speaking. Okay. I think this is the best way to do it. So sell secured puts. That means if hypothetically speaking, Tesla hit $200, not only you actually get your stocks for $200, but you lose nothing, isn't it, Tom? That's how it is. Like you acquired this stocks with your patient, but if it doesn't hit it, you don't exercise it, but you still keep the premium, right? Is that how it works?
Premium, yep. You keep the premiums, yep.
Yeah, so regardless, so everybody's willing to pay X amount of money for the specific stock, right? I think this is a good strategy for people who are willing to buy that stocks on the
It's a great strategy if your goal is to own the stock at a discount. Yep.
That's correct. So I think this is a good way because I think people are having a hard time understanding what is a covered call and secured puts. So, and covered call is like when you own the stocks and you would like to profit more, you'll do covered calls, but at the same time, you are going to make profit on whatever how much strike price you're gonna get in order for you to, I don't know if it's exercise it, so you make X amount of profit. So I think it's pretty simple. Now I think it's this is very subjective. I don't know if that's how it's supposed to be, but that's how I'm learning from Tom. Is that correct, Tom?
Ma'am. Yep. I think there's a couple questions in the chat too.
Okay, Tom, they said, I think you should be eliminating this for new students to understand properly, please. I think this is the most simplest possibly way that we could be able to
Yeah.
explain it to you guys.
Honestly, this is about as simple as you can break these down right
Yes.
now. For new people, right? And again, because you don't understand the concepts, and I'll be honest with you, I didn't understand these too when I first started, right? I was just a dividend guy when I first started trading, right? You pick these up as you go along, and once you started getting exposure to it, things will start clicking. It's just like when Mary does her charting, right? You're gonna go, what the heck is a flag, and how did she see that, right? You know, you've got to spend some time doing this, right? So go back, take these, like when this comes up, go back and watch it. And I hope I don't confuse anybody. That's not my goal. I literally had to scale this down. I was like, Mary, I'm trying to keep this under 30 slides. I could probably go to 90 if you, because there's so much you can talk about with it, right? But go back when the slides, the slide deck comes out, go back and start just pulling stuff apart, right? And looking at it and going, okay, and go watch some other videos, right, on people talking about these different types of strategies, and it'll start clicking. These are probably the simplest option strategies. These are probably the three simplest option strategies you can have. The ones I was going over tonight because we wanted to keep it simple. Illustration. Oh, aluminum. Okay, okay. Yeah, we're gonna do that. We're gonna try and do another class where we actually go through it, right? I'll bring up like a trading view and go in and do some of these. Um, FOVC's iPhone, and I can see him. He's streaming live. What about rolling a profitable put or call? So you're in profit and you want to push it out to gain more premium, I guess is the question. I don't know if you can answer
Yes,
me.
I think so. That's what it is, Tom.
Yeah, I mean, you can. I personally prefer locking in the profit and then opening up a new position myself. That's what I would do, right? Take your money and go, hey, I just made my 60 bucks on this one. Yeah, I had 100, but I'm just going to take it, open a new position because you could roll it and you might get some more premium out of it. But if you do roll it, remember now you're extending the time frame, right? And the longer the time frame goes out, the more it could possibly go against you. So I personally would take the profit, lock it in, and then open a new position based on what the stock price is at that time and what premiums you can collect. Make sense? Any other questions?
Yeah, Nick said if actual stock is a
Yeah.
thousand, like Costco, it could be very expensive to buy. Oh, absolutely. To buy one contract, like 1,000 stocks for 100 grand. Of course. For how many few $100? Well, just like I said, if you're planning to sell secured puts, is that correct? Sell secured puts, right?
Sure. Yep. You got to have the
So
money.
you're
Yep.
trying to acquire that 100 shares. So you have to make sure your account have that 100 shares worth of money. Let's say I think Costco is $1,000, you better make sure you have 100 grand. I bet you do if you have to. If otherwise, you will not be able to you will not be able to sell this put, right, Tom? And second, if you are in the margin account, then that's going to cost you a lot of money because margin, you have to pay for interest.
Yep.
I don't think that is recommended. I mean, I'm not a financial advisor, so as Tom, so as Ertuan, we don't recommend you to use your margin account because it's interest. It's not your money. You're borrowing money from your broker. That's
Yeah.
what it is. And
I don't know. I don't know if any of you have ever had a margin account pop up, a margin alert pop up on your account. I have. It is scary as hell. And luckily, I was okay with it because it wasn't huge, and I wouldn't say I was prepared for it, but it is scary, right? When you get a margin account, and you're like, hey, you're over leveraged here. You owe us $20,000. I'm like, what? But it worked out okay because I had bought protection, but it is scary.
yeah, when is
So
it?
actually, Nick got a great question, right? So, can you close sell put with other side of option contract? So, are you saying can you close sell put with other side of option? So, you're saying doing like I don't know if he's asking if you can buy a call on the other side.
Yeah, Nick, that's a little bit vague. Can you explain it to us? Okay, let's move on. When is a good
What's
time
a good
for
time for
margin?
margin? Ooh, so margin first of all, i- if you got the money right, again, you can't do margin in your IRA, so you have to have a cash account for that, right? And if you're doing margin, you're probably at one point get called on like pattern day trading. That's usually my experience with people who have margin accounts. So you got to have at least 25 grand, right? So my advice to people when you want to do margin is you better be good with your technicals. Yeah.
I think you should just stick to your money, just don't
Yeah.
overtrade and be careful. And if you're not that expertise on trading and you have a margin account, perhaps change it to a cash account.
If you become good with a cash account, right, and you're not you're consistent winning in there and this and that, and you build it up to the 25 grand, then you might want to think, hey, maybe I can do margin and start doing small trades. But yeah, do a cash account. That way, if you get it wrong, you're limited to that, right? Yeah, good advice, Mary. All right. So Nick, you asked about Costco, right? Hey, it's very expensive to buy 100 stocks, right? If you get called in that, great. So what if you want to sell a put, but you don't want to own the stock at all? You do what's called a bull put. So a bull put combines the short put, right? Selling the put, and then you're going to buy a put, right? So you're going to short the put by placing a higher value strike price. And again, we'll just use $100 Apple, right? Hey, I'll own Apple at $85, right? But you know what? I really don't want to own Apple. So I'm going to sell a short at 85. I'm going to buy at 80. So that buys me what's called protection, right? So if that stock comes down and it drops and I really didn't want to own it, I can actually turn around and sell it back at a certain price. right? At the minimum, it's at the $80. That is the bottom. That is the basement that you'll have to own the stock at, period. So let's go through that. Again, short put, right? You're gonna sell at the bid price, obligation to buy, right? Equity optimizes a bullish strategy. And then you're gonna do a long put. The right to sell the equity optimizes bearish put, right? So the short put is the primary instrument. The long put limits potential loss. So when I say potential loss, like I was talking about with the cash secured put, right? You had an option at 10. Now that thing's at 6. You own it at 6, even though you sold it at 10. So you're underwater, right? $400 per for the contract, right? And then, of course, now you're at $1,000 stock. That's a lot of money. So you don't want to do that, right? So you want to do what's called a bull put. You're going to sell the short, right, at a higher strike price, and then buy back buy another put at a lower price. Same expiration date, right? So you don't start getting fancy and doing calendar spreads and wing spreads and butterflies and all that stuff. Right, those are for super advanced traders, and those can be really hard to manage if you don't get it right. So we're just sticking with a bull put spread. Right, what is the risk? You have the obligation to buy the equity at the strike price of the short put. And then we also have the right to sell the same equity at the strike price of the long put. Our risk is the difference between the two actions. So if you've got an apple that you're selling at, and I'm going to use the same numbers, I'm selling it at 85. I'm buying it 80, right? The difference is $5 or $5 times 100, $500, right? Because remember, it's $5 per stock, 100 stocks per contract. So it's $500 minus whatever I got for the premium. So if that premium paid you, let's just say $75, now it's your max loss is $425 versus go back up to Nick's example, right? Hey, I did 100 shares of Costco at $100,000. What's my max loss? Your max loss, right, is $100,000, right? If that stock tanked. On a bull put, the max loss is the difference between the two strike prices minus the premium you got. So it's a great way to get premium and limit the potential loss. So the risk again between the two actions, you do keep the net credit, right? You don't lose the credit, right? The short put is best placed at or below support, right? Again, knowing your technicals is key to this. Where you're going to enter, right? Your strike prices. Do not place this trade during an option series where scheduled news events like earnings could cause the equity to change its direction rapidly. Now, that being said, I am managing some bull puts right now through the whole tariff wars, right? That I opened, 3 weeks ago, right? And they were all my technicals were spot on because of Mary's training. Thanks, Mary. All my technicals, they were spot on, right? My
That's your
Bollinger
doing,
Band,
okay? That's really your.
my deltas, right? My moving averages, everything was beautiful on these stocks. And of course, who knew, right? So but earnings is one you do not want to keep a bull put over earnings, right? Earnings can just blow it up on you one way or the other. If it goes up, great, you're fine. But I don't like taking those chances, right? I close my bull puts out. If I do open it, it's I look for a expiration date the week before if they have weekly ones, right? If it's a monthly stock, right? Monthly option stock, I don't do it the month of the earnings. It's just I've learned too many times that I've gotten caught with that. And I just don't like taking those chances myself. Some people like to play earnings. I'm not a earnings player myself. You can use spreads as small as 50 cents. Remember, 50 cents times 100, right? So there are ones that do $1, sometimes do 50 cents. The only thing with this is you want to stay with the ones that do. I like the ones that have the $5 spreads because when you look at your Greeks again, your Greeks are much better on those. You can do ones that have dollar spreads if it's a weekly, right? Hey, I want to do say a 95 and a 93. Right. The problem with that is if you have to roll it out, those may not be available those dollar spreads, right? As you roll it out, they may move to $5. I even had Costco a couple years, about a year or so ago. I was doing $5. I did three of these. I sold three of these at $5 spreads. Costco did a special dividend that they gave a special $15 dividend. They adjusted overnight all the options by $15, put me in the money overnight. I had to move it out and I couldn't get those strike prices. Now I had to move it out to $10 strike prices. I had to play with that thing for like 8 months before I broke even. So you got to be aware of that when you're taking your strike prices. $5 is usually the sweet spot between them. Put trade is a trade that optimizes a stagnant to bullish trend, right? You don't want the stock to be coming down, right? You really just want to get your premium and get out. The primary instrument is the short put, right? The risk limiting instrument is a long again. I like to go over this a couple times for people to understand it, right? Because you're taking two positions here. Reward is the net credit, and the maximum risk is the difference between the strike prices minus that credit. Again, you're selling a short put, right, with a higher strike price, collect the premium, buying a long put, right? So now the premium, if this premium when you sold the short put was $100, but now you're buying it at another one, $5 less, right? Now that one could be say $50. So now you're only getting a $50 spread, right? But that's fine. Yeah, I'm making money. I'm good with that. In fact, $50 is usually my minimum that I want to make on it to take that kind of risk, right? Anything less than that, if you've got a $5 spread, $500 spread, right? I'm not doing it for 10, 15, $20. It's just not worth the risk for me. It's got to be at least 50. I'm looking between that 50 and 75. Sometimes you can get up to 100. But mind this, if those premiums are higher, that's usually a volatile stock. Look at your your IV, right? The IV is probably going to be really high in that. Again, it's your Teslas, it's your Palantirs, right? It's all your Mag 7s, a few of your fintechs, maybe your quantum stuff that's really hot right now, right? That IV is going to be high. You'll get more premium, but then you got to look at what the risk is. And again, I always look for a delta of zero point 0.8. When you set your two strike prices, it's going to combine that delta and it's going to give you an overall delta, right? I'm looking for that zero point 0.8 combination, right? Or higher, right? 80% chance I'm going to collect my premium and get out. You're looking for bullish, moderately bullish or neutral, avoid bearish. Red days, red days are good days to sell this if the stock is a strong stock that you believe in, that you've done your due diligence on. Especially if it's one, again, if it's in your five that you're always doing it on, you know the patterns. You know what's going to happen with that stock, right? Why use a bull put spread? Collect premium, limit risk. Again, this is why I love this. I did get called again on some cash secured puts. I ended up owning the stock. Some of them I took losses on. Some of them the stock came back. I got wins. I said, you know what? For the most part, unless it's a stock I want to own, I don't do a cash secured put. If I just looking for collect premiums, this is where I go. Now you're going to collect less, but the chances of getting assigned are a lot less. I mean, sorry, yeah, not less. I don't want to own the stock, and your chances of taking major losses are a lot less. Sorry about that. Advantages: you define the risk. You already know what your max loss is going to be. You get the premium, right? Suitable for those bullish markets, right? So these are going to be great when our markets start, recovering. Eventually, they will. These are great strategies right here. Limited potential profit, right? You're capped, right? You're only going to get the premium because you don't own the stock, right? If everything goes your way, and it requires accurate market outlook, right? Again, this is not a good strategy if we're constantly in a decline and your technicals aren't there. Best stocks for a bull put. Actually, like I don't know why I put this because my chart was on the cash secure put. It goes back to the picture I had, right? The image I had of, finding the ones that are 50% institutional loan, that have 2 million shares trading daily, right? All that different stuff, and finding your five top ones you want to do this consistently on. Don't be jumping around on this, right? You want to find 5 or 6 stocks, and then maybe make a watch list of another 10, right? As those stocks start to um, uh, earn your trust, so to speak, right? With their movements, you maybe want to start moving stocks in and out based on what they're doing. But you don't want to be trying to jump around and do every single stock because somebody said, hey, this is the stock to do, this is the stock to do on this one, right? All right, selecting your strike price. Again, same thing as we did with the cash secured puts, except we are not looking for in the money on this at all, right? We don't want in the money. We want out of the money, right? Delta of 8 or higher with the combined long put and the long position and the short position, combination of 8, chance of greater getting out of it. Do your technicals. You can go close to the money if you want, right? At the money, I wouldn't do it unless you want to own it. I wouldn't do it. You can move it closer if you believe if it's gonna move up, right? And you want to collect a bigger premium. Again, I tend to look for this 8. That's my goal, is the 8. And if you want to go to a 9, that's how you want to figure out. Again, your max loss is only the difference between it. You're going to get a higher premium. So you may get, you're doing a $5 spread, you sell the contract, right? You get $150 for it. Your max loss is 350, right? But if your technicals are spot on, and I've done this myself, if your technicals are spot on and you know what you're doing, you can collect that premium and get out of it. Oh, Lisa, I'll get to that question, Lisa. We will get to that question. All right. So I kept bringing up Apple because on this because I knew I had this slide coming up, right? Say Apple's trading at 275 per share, and you want to do a bull put spread. I sell the option at 850, right? I collect the premium, right? So I get the premium, and then I'm going to buy this premium back. I'm going to buy protection. That's what it's called. It's buying protection at $2. So what did I just earn? I earned $6.50, right? Times 100, $650. And there are contracts out there you can make this kind of money, right? And now, but look at the spread. I'm at 280 and 270. What did I say I like to do? I like to do $5 spreads, right? Because I don't like this $1,000 difference in between here. But on something like this, if you're getting 650, your max risk is now, right? 280, 270, $1,000 minus the 650, your max risk is $350. That might be something you'd be willing to take, right? Especially if you're saying, hey, Apple's on its way up, right? I've got my strike price set. I've got my expiration date. All right. I'm not going over any kind of earnings, right? Where stock prices can drop. We've all seen earnings, right? Um, I work for a company, I'm not going to name it, a tech company that has great earnings every single time we come out. Yes, we beat, we beat, we beat. And then our CEO goes, and the stock drops, right? Because they say we see headwinds here, we see less spending there, right? Even though our financials were great, right? And you see what every one of these companies, right? Somebody just says one word, and even though the company hit all its numbers, it drops. That's why I don't carry any kind of selling these options. I do not sell them over expiration date, not earnings date, excuse me. So this one, in this scenario, you collect 650, that's a great premium, right? If it goes your way, that 650 is yours, rinse and repeat. Okay, things to consider again when you're doing these, right? These are time decay sensitive plays. Just like when, even when Josh is doing his scalping, right? All when you're doing options, they're all time sensitive, right? Options lose value as they approach expiration. Now, on a covered call, it's great when time decay hits, right? Because that becomes less and less, and you're still under your strike price. Cover calls, you love time decay. time decay on this actually works against you, right? Because they lose value. So if you have to buy it back, the value that you sold it, that you got the premium for, becomes less and less. You end up buying it back for a little bit more sometimes than you paid for it if you want to get out of it. Volatility, right? The IV. You got to make sure your IV is going to make sure it doesn't affect your profitability. So always take a look at that. Your early assignment, right? There's always a risk of early assignment. This literally just happened to me last week, right? Microsoft tanked. It was way under what I had originally did my bull put for. I got assigned, right? I got assigned at the long call, right? And so when you wake up in the morning and say, "Hey, you just got assigned," and you're assigned at $600 times 100, 60 grand, right? If that was a cash secured spread, right? What's Microsoft trading at last week? 500. You just lost $10,000. That's why I love these, because now I had bought protection. I had bought a $5 one underneath that, right? I turned around and sold it. So yeah, I lost money, but I lost money. The $500 minus the premium, my premium was like 180 bucks. I lost $300 on it, right? But those are the chances you take. And that's why I like buying protection on these. Rolling the spread, right? Again, if you see it moving against you, you can roll these out. I do it all the time. I just moved Nvidia and a couple other things over the past couple of weeks out till May, right? Hopefully we get start getting recovery. They were too close or they were underwater enough where I didn't want to take a chance at getting assigned early. Again, you got to watch your assignments being early, right? If you're within a week of your expiration date and you're underwater on that, unless you want to just take the loss minus your premium, you may want to look at moving that out. Moving it out a lot of times will cost you a little bit of money. It all depends on what you're willing to spend. If it's less than what you would do if it got assigned to you, then you might want to move it out. If it's not, you may just have to close it out and say, hey, I'll take the loss on this one. Again, closing the option. I love closing these when I'm at 50% or more and I still have half the time expiration and then reopen in a new position. And it's great when you can do this. And sometimes you do it in the same week, right? You collect that premium, you close it, you pay, you buy back a little bit, and then you open up a new one. So then you double it, right? You double your position easily in 1 week. Close option before expiration date. Again, if you want to lock in profit and avoid a sudden move on that option. And this is what we all end up want to be at the end, right? We want to be Tony Stark, just letting the money fall on us. All right, so that's the end of that. Questions about bull put spreads? I know we got a few in the chat too.
But before we proceed, I would like to give you guys a little definitions when it comes to selling puts. When Tom said we're going for a long put, what does that mean? It means that you're buying the put options, okay? When we say we're going for a long put, because I've seen a lot, long put, short put, long put. I'm sure a lot of people may not, or maybe you guys know, but I just want to simplify it. When you're going for a long put, this is when you go buy your put options. It's like when Josh saying, okay, let's go ahead and do a put options. This is your long puts. Okay, so it means you have the right to sell the asset, but not the obligation to buy it. And then when Tom said, let's go ahead and do a short put, short means you are selling an option, but you have the obligation to acquire the assets. I hope, is that make sense?
Great explanation, Mary.
Yeah.
Okay, and also for the long put, when you buy put options, like Josh, the setup for put options, you're betting that the stocks or your options will go to your favor. It means it's gonna go down. That's the only way you will make money if you do long put. You want the price to go down. But if I believe from what I'm learning from Tom, if you're going for, please correct me if I'm wrong, if you're going for a short put, you're selling a put options, it means you have the obligations to acquire this asset, but you're betting for the price to remain the same or at least go up a little bit. Is that correct, Tom?
Yep. And it depends where you set your stock price too. You can even have a slightly bearish one, right? As long as it doesn't come down to your strike price. Yep.
That's correct. That's correct.
Yep.
So that's what I'm understanding from Tom. So I would like to simplify from you guys, and I think I am able to simplify. Another thing is that I've learned from Tom is for the capital requirements. Like if you're going for a long put, it means you're buying a put options. You're only required to buy for that cause of the premium, which is very minimal because you don't have the obligations to buy the asset. So let's say the premium is $2 because you're gonna go buy put. That's the only concerns that you just have to worry if you're paying for your premium. So it means your capital is smaller.
Yeah.
For
So
a
Mary,
short
Mary
put,
made a great point.
you requires a sufficient margin or a collateral to cover your potential loss, or if you have bought by that
So
stock.
that's perfect, Mary. Yeah.
Right?
That's another reason why I like the $5 spreads. When you do a bigger spread, you have to have that cash available, right? In case the play goes against you. So if you do a $5 spread, right, you technically need $500, right? If it's one contract minus the premium. So if the premium is 100, you only need $400 in your account to make this play, right? If it's $1,000 spread minus the premium, say $200, you need $800. Where cash secure put, you need it all. That's why I love these plays, because if you have a smaller account, you can start making money off of this. So if you have a $2,000 account, you're doing $5 spreads, you technically could open four plays at the same time, right? And do that because you only have to have the a cash available that's required between the two positions minus your premium.
Yes, that's what I'm getting from you, Tom.
Yeah, lot less money required to do a full put spread. Yep.
Questions. Oh, what are the questions that we have? I heard margin account save on taxes. Can you talk on that? Okay, for this one, this is an accounting purposes. We are not a financial advisor, but when you say saves you on taxes, that means there's a lot of things. One is a wash sale. That goes for either cash or margin. But if you are in the margin account, you're gonna get triggered if you buy and sell options or you buy and sell the same day. And if you did that 3 times in a week, you could get triggered as a day trader. Is that correct? Right? That's my understanding. Right,
Sometimes,
Tom?
yeah. If it's a margin account, yep.
Yeah. So for a cash account, you don't get triggered on that as long as you are able to cover your trade. But the watch sales are both for margins and for cash account. So if you don't want to be triggered as a wash sale, you have to wait 30 days, at least 31 days so that you can be able to depreciate it on your taxes. You could file taxes for a loss for that. But if you buy and sell it within 30 days and you lost, you cannot depreciate that loss. Right? Correct? Is that correct, Tom?
Yeah, so actually, it's funny you bring that up because my accountant just scolded me last week when we did our taxes about my cash account, and she goes, you keep buying and opening these positions on this same. It was the SPY, so you can't get the wash on them because you're literally doing it. How many times a day you're going to do this?
And
Yeah,
all, yeah,
can't
and
take
also go
the
ahead, Tom.
tax. You can't do the tax harvesting, right? If you're taking a loss, right, in the wash sale, yeah, it doesn't help you out. So, and I always say when people talk about taxes, right, talk to your accountant because there's some things that are just, and again, if you're trading in your IRA, like, most of my trading honestly is in my IRA because I want to avoid the taxes. I have a Roth. Honestly, my Roth is strictly dividends and cover calls. I don't do any kind of thing in my Roth, right? Other than that, my traditional IRA, I keep cash on the side to do these kind of trades, and I won't get hit on the taxes until I take it out, which hopefully won't be for another long period, right? When I'm at a much lower tax rate than I am now, and I think Airtwan was just talking about that on Discord today, right? But if you're working out of a cash account, it all depends. Did you take a loss for the year? If you take a loss for the year, then you may want to reevaluate your trading strategy. If you're taking a win, and you're winning, paying taxes is the least of your concern, right? That's what I've always heard. I haven't seen it in my cash account yet, but that's what I've always heard.
But please, if you are new to trading, we don't recommend you touch your IRA or your Roth IRA for trading, okay? Let your financial advisors handle that until you become familiar with this type of trading, please, because I've heard a lot of people sending me messages, Mary, I blew up my RIA, what do I do? And I'm like, I felt so bad and I could only help so much. But please, if you guys are new to trading, don't go ahead and uh take your IRA and you trade it yourself. No, I don't recommend that, please. Wait until you are very familiar with this and you're confident enough to manage your own IRA, please. Right, Tom? Tom has been doing this for so many years, I'm assuming, so he handles his
That is great advice. I tell people all the time, right, when people come and ask me, and not that and I told Mary this the other night we were talking. I said, I am not the greatest trader. There's a few things I can do well, and I always give advice to people. If you're not somebody that knows this well enough, right, keep it as simple as possible, right? Start off with dividend stocks, ETFs, right? Learn covered calls. That's why we did this class, right? These are the simplest things to do. Cash secured puts are easy, and if you're doing it with a you've got the money, right? And again, IRAs, I don't recommend over leveraging yourself ever in your IRA, right? Because that's your nest egg. But like a bull put spread are great because you're limiting your losses, right? But then again, you still got to look at, what is the amount of money I'm willing to risk, and I've always lived by, um, depending on what your IRA, or whatever your account size is, whether it's an IRA or a cash line, don't go more than 5% of what that value is on any particular trade, right? You do not want to put yourself in a bad position where you're losing money and then you start revenge trading. So, yep. We want to go through questions, Mary?
Sure. First one. Okay. Delta available with option screen. Tom will share his screen with this sample some other time because it's too much for you guys. I mean, it's too much for me already. So imagine, for everybody. So we will go. Probably whenever Tom is available, we'll go over and see the examples of how it really looks like on the real platform, and then we'll discuss this more. This is not going to be the first time or last time we're going to discuss this. We'll elaborate it more, right, Tom? Because I know it's too much. It's overwhelming. I could see a lot
If
of
we did
questions.
examples, we'd only have covered one subject tonight.
Yeah, and Tom has more ideas and more things to teach us. So, but before we move on to that level, I would like everybody first to be on the same page, and we're all going to move together, not just because one person succeeded or one person is thriving faster than the other. No, we all have to be moving together. That's the goal. This is a little bit complex from everybody because from technical, we're just learning candles, patterns, and now it's different ball game. This is a different environment, guys. Okay. So this is a risky trade compared to buying and selling shares because this is options now. Another question, if I understand it correctly, once you collect your premiums, you can close your position on a covered call.
No. So if you do that, right, you collect your premium. If you do go ahead and close it, so it depends on what way the stock moves, right? If you go ahead and close that position, but your stock has moved up, you're going to have to buy back, right? You can't just close it. You're going to have to buy back, right? So it's going to eat away at your premium. Depending on how far that stock has moved up, if it's gone through your cover call, you're going to end up paying money, right? So it's not just, hey, I collect my premiums, I'm going to close this position out, right? If the stock has remained neutral and the stock is maybe even slightly declined, yeah, you can close it. You're still buying back, so you will have some kind of cost associated with that, but it's going to be a lot less. Yeah, it's not a straight, hey, I got my premium, I'm going to close this out. Yeah.
So it's not as easy as buying an options because the buying options or buying put options or buying calls options are just easy. Click buy and then you sell. That's as easy as that. But I think covered calls is more complex, right, Tom?
It depends, right? Again, it all depends on what position that the stock has moved, right? Again, if it's neutral, slightly bullish, you can close it and just have the difference between what you paid and what you sold it for and what you paid for, right? If it goes above it, then you're gonna, and if you're just trying to close it, you just want to keep the stock and close it, you're gonna end up paying more than you probably got the premium for, in my experience.
Okay, that makes sense.
Yeah, because it's gone past your cover call, right? It's gone past your strike price.
Hmm.
Yeah, so now the stock is worth more than what you sold the cover call for. So they're going to charge you for that, right?
Well, is it advisable for you to close that before
If you
you?
want, so if you want to keep the stock and that stock, the difference in the price moving up has overcompensated for what you're buying it back for, then you could, I've done that. Yeah.
Okay. So I
Yep.
think that's the safest way to do it.
Yep.
Do you think it's wiser mastering
Also,
buying?
there's another thing too, is you can close it and sell it, right? You can sell
Yeah.
everything, right? Hey, you know what? This stock has risen enough where I want to take my premium, I want to close the position, and I'll sell the stock, and you
Yeah,
still make. Yep,
double profit.
yep.
So he said, do you think it's wiser mastering buying options before doing spreads? I think it's wiser for you to learn technicals first before you do options. And then once you're smart enough, not smart enough, that's the wrong word. Um, you could be able to read the chart better than before. Then I think you do paper trading and then do your options, buying options with a limited budget, like small budget first, like $200-300. Start small before you start losing money. You know, if you start with a bigger budget, there's a higher risk of you may lose that budget instead of like mitigating it or mitigating your risk to like a smaller position. And buying options also is if you would like to start doing options, start with Spylord. I highly suggest with Spylord first before you go with Josh because you're gonna keep pulling your hair. I'm like, when did he enter? When did he enter? And you're gonna be frustrated. So you want to start small, you want to start slow, but at the same time, you want to build up confidence. Right, Tom? You would like to add
I
something with that?
so Yeah, so I cannot advocate enough on Spylord's behalf. When I first joined Discord, like a lot of people, and that's why I volunteered to become a moderator, I was lost on this Discord, right? There's so much, and I belong to other ones, but this one is so active and there's so much going on. I was lost, and I saw Spylord posting this and that, and I was like, you know what? I'm just going to ask him a quick question. And Michael is so good at reaching out and saying, "Hey, let's connect," right? And so he started answering all my questions, this and that, blah blah, blah. I started joining all his lives. His ability to stay calm on these plays is amazing, right? I'm not naturally a calm person, and there are many times where I want to throw my mouse at the screen. Right? Spylord is great. He will help walk you through this stuff, not only during the live trading, but then you connect with him later on. He does his night. He'll do a lot of times. He'll do a night recap. And he's very good at going back. And I told somebody on the Discord the other day, when your trade goes back, don't just trade goes by bad, excuse me. Don't go back. Don't just say, "Oh, the heck with it." I messed up. I screwed up. We all do that, right? Go back and look at it like a crime scene. Investigate why your trade went bad. Michael Spylord is very good at going back. He actually showed me how TradingView can replay the day and go back and look at what you did wrong on the trade, right? What you maybe you had a wrong entry price, wrong exit price, stop losses, too close, right? Those kind of things. Yeah, Michael's great at new traders on buying options. He's fantastic.
And to add with that, I think we all know what we did wrong. Honestly, we all know what we did wrong. And you know what it is? It's our emotion and lack of strategy. That's what it is. Because I know what it is. So when I know when my trade is going bad, I know when to stop it. But guess what? It's just that one hope I know it's gonna go up. It's just a hope. So we know we're supposed to be following our strategies here, not our emotions. So I think that's what it is. I think we all know what we did wrong. I mean,
Yeah,
it's very wrong for you for us not to admit it, but we all know what we did wrong in there.
yeah. The
Yeah, it's over
next
leveraging, yeah.
the next two questions are yes. Is a bull put spread same as a vertical spread? Yeah, other people call it vertical spread. It's also called a put credit spread. Yeah, there's different names for it. The most common really is a bull put credit.
If a high IV when you get more premium or something. When you do high IVs, it all depends which one are you trading, right? So if you're going for Tesla, you're going long, you're buying puts, you would like to have high IV, yes, because that's where the money is. If you pick a stock or options that's low IV, it means your probability of becoming profitable is very slow or very little.
Yeah, the other thing too with the difference between IV, look at the number of contracts based on the IV, right? If the IV is high, there's a lot of contracts, which means
The
the chances
volume.
of you getting your contract at your prices are great.
Mhm.
It also means that if you need to move that contract, you need to roll that contract or adjust it, the chances are pretty good you can get it. If the IV is low, you're going to see that the contracts are low. There's a little chance that you're going to get at your numbers unless you do maybe a market. And also, if you need to move it, it's going to be hard if IV is low because then your open contracts or your interests are going to be low too. That's one thing I learned quickly.
That's correct. And also you look at your volume because if there's no volume in there, there's no way you could be able to buy or sell that quickly. You might be ended up being stuck with that options, just to let you know.
Oh. Scott Young, I feel you, brother. Stop loss. I'm the guy that says I'm down 80%. It's gonna come back. Can't tell you how many times I did that on buying options. It's gonna come back. I know it. Somebody asked about Tesla. I'm gonna leave Tesla charting to Mary. Tesla, I'll be honest with you, I have a love-hate relationship with Tesla. I love it for a long place. I own quite a bit of Tesla. I mean, not Josh size, but for my size, pretty good amount of Tesla. Because I bought when they did the splits, right? Um, I don't like trading options other than cover calls on Tesla. I seem to get it wrong every time, even following Josh, because I'm not willing to set, me personally, I'm not willing to set like a 40-50% stop loss when I'm buying a put or a call. It just doesn't suit my blood pressure very well. So can Tesla hit 150, Mary? Good. And
Well,
and because there's so many things at play, right? People who used to love Tesla hate it because Elon is aligned with Musk, and I'm not going to go politics though, but that's a fact, right? Tesla is so volatile because of Elon has so many different things. People say he's not focused on the company sometimes, right? And that changes things, and it moves so fast day to day. There's so many things that play against Tesla. Is one of those stocks that defy a lot of your expectations of the stock market constantly. So I don't do options on Tesla at all.
yeah, let's focus on what we discussed today. We could take a look at charts after we finish with Tom. Any more questions for Tom? Well, by the way, Tom, thank you so much for taking your time to do this slides. I know it's time consuming, and please send our regards to your wife. We appreciate her for sharing you to us. We appreciate her so much. And thank you also for, again, giving your time, give us a great
I,
information about covered calls and all these options. I'm
yeah.
also have limited knowledge on options. I mean, not going long, but for those covered calls and selling puts. Any more questions for Tom?
If you guys do have questions, right, you can always hit me up on Discord too, right?
That's right.
Um, I constantly on it. Yeah, we're gonna Lauren. Mary's gonna. I sent Mary the slide deck as a PDF, so she'll share it out later. Right, Mary? And I
Yes,
think
I
this is.
will put it.
Will this go on your YouTube channel later too?
Yeah, we have a YouTube channel specifically for this class, so it's not something sponsored. It's just for our class for us to learn.
All
And
right, I'm gonna
yes,
stop sharing then,
I'll go
Mary.
ahead and forward the PDF for Tom, but this is going to be recorded so you guys could go back and retrieve all Tom's information regarding his slide. And Tom, thank you. Let's go ahead and take a look at
What's
chart
your
now.
name on Discord, Tom?
I'll put it in the chat. I am AR Pats fan.
Thank you.
I'm the guy with the Patriots logo. So if you don't like the Patriots, too bad.
Yeah.
I'm gonna share what arm pads looks like. Okay, do you guys see my screen?
Yes.
That's him right there.
I got called up one time when Josh and Larry were doing a combined thing, and they pulled up one of my posts, and Larry called me, a Pats fan. He must be a pirate. I'm like, no.
So
Tom?
that's Tom.
Yeah.
Okay. He has the
Thank
teal
you.
color because he's a moderator. He's a junior moderator. All right, let's
He
go
has a
ahead.
question.
Yeah, Tom. Yeah, I just had a question about the credit spread. So in that example with Apple, if it hits 280 and you sell the put, then you have an obligation to buy those shares. But then what if it never hits the 270? So you can actually buy those shares to.
So that's a great question. So say it hits 280, right? Say it hits 279, right? So yeah, you just bought it at 280. Guess what you can do? You can sell at 279. You don't have to sell it. You don't. You get protection at 270, but you can go to your brokerage and say, you know what? Yeah, I just got to sign this at 280. I want to go ahead and sell it at the current stock price. You sell it whatever is higher. So if the current stock price is higher than your what you bought that protection at, you sell it at that current price to limit your loss, right? And I've done that. So again, 280, you get a sign. Now the price is 279. You go call your broker. Hey, I don't want to own this. Sell it at 279. Now your loss is only the difference between the 280 and the 279 minus your premium. Again, reducing the amount of your loss is your goal, right? In that scenario. Great question.
But I thought the point of the credit spread is so that you don't have to have the cash on the side to actually buy.
Don't you don't. But what you're gonna get assigned, right? You have to actively go in and either say, hey, exercise my long put, right? The 270, right? Which means you sell it at 270. But if the stock's at 279, you don't want to do that, right? You want to go ahead and sell it at 279. You get time to do that, right? It's not like when you get assigned, it's not immediate. Give me the money, right? On that, you can go ahead. Like I've got assigned, and I call up E-Trade the next morning, and I don't even have to call them anymore because I know what I'm doing. But when I originally started doing this, I would call and say, "What's the best thing for me to do here?" And they would tell me, "Hey, the stock price is above your long put, right? That you bought it for. You want to sell it at that price. You reduce your amount of loss." Does that make sense to me?
Um, Sorry, I'm still a little bit confused. So when you sell the put and it gets assigned, then technically you're supposed to have the money to buy those shares at that price.
Oh, no. So if you're doing a cash secured put, yes. If you're doing the bull put credit spread,
Mhm.
no, you only have to have the amount between the two. Because the worst you're going to do is selling it at the 270. You only have to have that $1,000 minus your premium. That's the most you have to have. Now, if you get assigned and you say, hey, you know what? I want that stock at that price, then you need that money. Yes. But your goal here is not really to own the stock, right? On a bull put credit spread. Your goal is to collect premium. So then you turn around and tell them, hey, I want to either sell it at whatever my long put was, the 270, or the higher of the two, which is the stock price.
But then what if it doesn't reach the 270? You can still do that?
Yeah, you can sell it because now so look at it this way. It's a temporary ownership, right? Of the stock until you settle it. Now, if your expiration date hasn't come for those puts that you assigned early, right? You're signed early. You're signed before your expiration date. And that, again, that just happened to me last week, right? You're signed early. to say a week before the expiration date, right? For some unknown reason. Now, at that price, you probably won't get assigned, right? People are looking to make money. These institutions are looking to make money. They're probably not going to do it at that the stock price at 279. But if it does happen, you can sell it at either what you bought that put for, that protection put, or if the stock price itself at that time you got assigned is higher than that put, you can sell it at that. And then you only have the difference between what you bought it for, the 280 that you're obligated to buy, and what you ended up selling it for. In this case, we're saying it's 279, right?
Okay,
Yeah.
yeah,
That's
that's
confusing. That
yeah,
caught me the first time I got assigned too, right? And it was in between. And E-Trade told me, hey, you don't want to exercise that option. You're going to take a bigger loss. You want to sell it at the current stock price, which is higher than what you bought protection for. Yeah, that's why I said this is it's a great tool to have because it limits the most you're going to have is that bottom put. You may even get better off and sell it at a price higher than that bottom put. Even in the best scenario too, right? Is if say you get assigned and you'll get assigned overnight. It won't happen during trading hours. It always happens overnight, at least with E-Trade. It happens overnight. Say I get assigned at 280, right? Because it happened, and that's the danger of carrying options, right? You can get assigned even when you're sleeping, and it gets assigned to 280 because it closed above that. At the end of the day, you get assigned, and now um, you come back in the next morning, right? Apple's at 285. Guess what you get to do? You get to sell it at 285 because now you temporarily own it, right? You can
right,
close out your other position, right? Sell it and collect the increase.
right.
Yep.
Okay, all right, thanks.
Yep. Yeah. The most you're going to lose is the difference between the strike prices and the premium. The most. That's why I love these.
I know it's a lot to
It
comprehend.
is.
We will, yeah,
We
the
didn't
only
cover we
way.
didn't cover every variable, Mary. There's no way we could have, right?
Yeah, so what we could do is we could try to go over it multiple times. As long as Tom is available, we'll make it as simple as possible. Perhaps Tom will start with covered calls first, and then we'll
Yeah.
give examples. Let's do that. And then after covered calls, we'll go ahead and do the shorting the puts. Will that be better for you guys? And we'll do an example. I know it's a lot. I felt like everybody is like, everybody's scratching their head. I mean, it's not everybody, others. So we could try to, I'll talk to Tom and see what is the simplest way that we could possibly do it. Whatever Tom is available, I'll just Tom, give me a call or whatever. Just shoot me a text, Mary. I'm ready. And we just discuss it maybe me and you work together with the presentation and start from covered calls if that's too much for you,
Fine. Yep.
and then we'll start from there. I felt like I feel like most of us are lost. I mean, I understand the cover calls. I'm a little bit confused still with vertical spreads that you were talking about. But I think I will start first with covered calls. I think that's what more I'm familiar, and also the secured puts. I think those are most the
Oh,
simplest
that's
one,
you.
right? I think those are the simplest one that we could discuss. And then as the time goes by, that we become more expert, then we could move forward for the spreads. But those people who are learning right now, you are more than welcome to do, as you please. And you could start practicing. Actually, start practicing with covered calls. I think that will be better. And start with a small position, like one contract. Look at your portfolio, whatever stocks that you have. I mean, lucrative stocks will be better if you have 100 shares and start, selling covered calls. And
Can you practice all these on paper trade? All these
or you
com
could do paper trades. Thank you, Big T. Yeah,
Can
that's
you practice all these on paper trade?
Yes,
mm-hmm.
sir. Yep.
Yeah. Okay.
Yeah. You
The
could
only,
do
the only thing with paper trade, and depending on your platform, I know with E-Trade, um, just to give you a tip is with paper trading, Just do a market orders for paper trading, because that way you can see the action happening right away, right? A lot of times with paper trading, it takes forever. At least with E-Trade, if you paper trade and you set limit orders, they don't go through sometimes. So I always set market orders. But yeah, you can do all these type of strategies with paper trading, and you can practice your adjusting the trades too, right? So if you do one, and you're letting it sit, and you say, hey, I notice the stock's changing in direction. You can a great way to practice how to either roll out, roll down, right? On your adjusting your trades. Paper trading is a great way to do it. Yeah, great suggestion.
Okay. Thank you.
Do you
Yes,
guys, sorry.
go ahead.
Yeah, do you guys know, like when you buy a stock, sometimes you can place, I think it's called a bracket order, where you can set the price at your entry, set your stop loss, and set your take profit at the same time. Do you know if that's available for options? Because on Fidelity, at least, I don't see that as an option.
You're talking about a one cancels the other?
I think it's called one
Yeah,
OT.
yeah, they call them different things. Yeah, I know, like I said, I do, unless I'm working in like buying options, I use Webull like for the buying the options because it's fast. But for my regular trading, I'm old school because all my company stock is E-Trade. That's why I learned it. E-Trade does give you the option to do, you can set like a take profit or set a stop loss, like a one cancels the other. Yeah, you can easily do that.
A trailing stop loss.
You can do trailing stop losses, yeah, but you can do a one cancel the other too, right? Hey, if it hits, and I do this a lot with the scalping, like on the leverage ETFs. I'll set a 5% close this, right? Take profit at 5%, or if I'm down, 20% close this out, right? I'll take the loss. That way you don't have to sit there and play with them all the time or watch them if you're doing other stuff.
Yeah, Weibo is very user-friendly compared to Schwab. Schwab, especially if you're using mobile, you really cannot do that. You have to cancel one order before let's say you have a stop loss, right? Limit stop loss, and then you're profiting and you would like to get rid of your stop loss, your limit stop loss. You have to stop that first. You have to clear that out before you create another order. So that's the only thing with Schwab. It's not user-friendly as a Weibo.
Hey, Mary, I'm going to be right back. I don't know if you noticed, but I've been drinking out of this container the whole time, so I'll be right back.
No worries. No worries. Thank you so much. While we're waiting for Tom, let's go ahead and take a look at the chart for this is Tesla. I don't have Weibo or Robinhood. Can you guys take a look at what's the current price for Tesla now?
216.
Oh, okay. So actually our support is on that 214.88. This is the support for this one. If we look at the monthly, we have this rising wedge. And you know what's a rising wedge, right? A rising wedge is what pattern? Bullish or bearish?
Bearish.
Bearish, thank you. This rising wedge is similar to NVIDIA that we've been watching pretty much for a past couple of weeks, months. This is also a rising wedge. And we saw NVIDIA trading with a rising wedge. We said that it hasn't broken down. This is the same thing with Tesla. And right now, Tesla hasn't broken down the rising wedge in the weekly. So if we are right here, 218, 213, okay. This is 212, 213, 214. So this is your support for the weekly right here. If we break below that, 217 to 213, if we break below that, there's a possibility that we could reach all the way to 200, 201. So it's about lower 200, right? But we have this 325 EMA on the 195. Yep, 195.91. If we fall below that 195, Tesla will be considered to be in a really bearish territory. This teal color, this is my 250 moving average, and we are being respected last week. But I think We are now below that, so we are either going to wick up or will give us a continuous bearish candles. This long wicks are what? What do you call this wicks? Rejection, continuation, or what? Confirmation, what is it? When we see long wicks on any kind of resistance, dynamic resistance, or any kind of resistance, what does that mean when we see wicking candles?
Reject.
They're rejections. That's correct. So we have rejection candles, two rejection candles, and then if we have a momentum, bearish momentum candle here, it's going to be so bearish it's going to continue to fall for Tesla. This is a lot of volume. It means there's a lot of selling pressures on this last week. This is higher than this one, although this is lower, but this is higher. But look at your volume. It's a lot of selling pressure. So right now, the goal is to maintain at least 213, 212. Otherwise, we'll be seeing Tesla on the 200, below 200, all the way to 196, 195. So that's right now the support, the local support for Tesla. I don't want to give you guys a more bearish scenario. And if we do, we have 185. This is a psychological support because it means it's even. We have 185. We have 168 again, or 160, all the way to that 146, 145. That I think somebody just asked, will Tesla fall below 140 on this level, these two levels here? Will Tesla hitting here? I want you to pay attention with your 325 EMA. Well, first of all, we have this 250 MA on the weekly. So if our candle for tomorrow opens below this, then it's bearish. It will continue to be bearish and might definitely test Tesla here, all the way here. Just watch your 325 EMA and your 250. Let's look at the daily. The daily, we have this M pattern, right? And what do we say about M pattern? They are bearish. That's a possibility where we're going to hit Tesla. It's already passed. That's the neckline. So Tesla might be right here. You might do a reject and then fall back more. I don't know, but that's just a scenario for Tesla. It's not looking very good. Let's go take a look at the RSI. I think I saw a, give me 1 second. Okay, RSI, we are in the bear territory. Let's take a look at the weekly. Our MACD fall below negative, which is below 0. So when our MACD lines hit below 0, what does that mean?
Bearish.
Bearish, that's correct. This is MACD plus means we are bullish. If we fall below 0 here, it means we will continue to be bearish.
Quick question, Mr. Green.
Go ahead.
So when it drops below the 0 line, that's bearish. And just quickly going back to like the trade setups in the day, you said that the MACD should be pointing up for calls and down for puts. Does it matter if it's above the 0 or below the 0?
That's correct. If you're going scalping, and first of all, you don't look at the weekly, okay? You look at the 1 hour MACD. You look at the 1 hour MACD. If you're going for a put, you would like it pointing down. It'll be better if it's in the bear territory than on the bullish territory. But yes, the MACD will tells you, at least it will give you a hint that, hey, the market might be going for a put or going short. If this is pointing up, it's supposedly that the market might be going up. So you should be going for a call. Based upon Josh that I've seen from him, it doesn't matter if it's on the bull territory or the bear territory. Just the concern there is the MACD line has to be either pointing up or pointing down.
It doesn't matter if it's crossed the signal line at all, right?
No, but if you're going for a call and then if the MACD line is crossing above the signal line, that will give you like more confident that, hey, this is really going for a bull territory. Will be more going to your favor if you're going for a call options. It's like an extra confirmation that yes, it's going to be in a bull territory or it's going to be in the bullish trend, but it'll be better. Absolutely. It'll be better.
Okay, thank you.
It's like an extra cushion for you for your trade. What else for Tesla? Oh, Ethereum. Horrible, horrible. I think we discussed Ethereum last week pretty much. I said that our support was 18. We fall below 18. We have 15, right? Do you guys recall that? Okay, nobody recall it, but that's fine. So we do have a flag, which is this is actually a bullish flag, right? More like a pennant, perhaps. And another bearish pattern, a pennant actually is a bull pattern, but we did have the M, and this is a continuous lecture for you guys. M, when it's break below the neckline, it confirms the downside. This candle confirms the downside, and especially this is the monthly, so we will continue to go down. So we are here as one of the support. The next support is here. This level, $1,100, or this candle, $11.90. Then the next one is this level, about that $900 again. I hope not. And then of course this wick that we have in here, and this wick is about 879. So these are the level that we have to watch for Ethereum. This candle,
It is bouncing off of 1538 right now, Mary.
it's still in the $1,500. Yep. So we are in the support. We're still in the support. It's right here. So we just completed an M pattern. However, we just had a breakdown to the downside. So it's looking way bearish than we expected. Hopefully it holds up 1,500. But remember, ETHU, those people who have ETHU, this is a bull ETF. So if ETHU is twice of a bull, it means every time Ethereum goes up, our ETHU will go up twice. However, if we're falling 4 times. It doubles your losses, just FYI.
Any thoughts on how bad this can get if things really continue over like the next month or so? I don't think I've ever seen the market drop this quickly.
Yeah, we weren't expecting actually Ethereum to be falling because we really have a nice bull flag on here, and we just thought that it was just consolidating. But I think it's more of the market sentiment that everything just continued to fall. You know, the tariff is not settled in. Everybody's scared. Number one is really the tariff.
Yeah. No,
It's really the tariff. The lowest we could possibly see is back to $900 to $800. That's your worst case scenario. Yep. That's my average. Is it?
Yeah, just in terms of like the general market, not necessarily Ethereum.
Oh, but I don't know how much. I really don't know. I'm not a fundamental person, but somebody could help me. Yeah, because if we have an M pattern on the monthly, we are literally seeing that $1,000 to $800 for Ethereum. Like how many more bleeding could happen? It's for our Ethereum, it's not looking good. And please, I don't advise everybody to DCA on their losses for Ethereum, for ETHU, because we are doing a reverse split. And usually when we do a reverse split, what happens? It will continue to fall. So this is times 200, I mean, times 20. So how much is that? A little below $40. How much is that? Like 178 times 20. Can you, somebody? 17, 17, 30, 30, 39. Is that correct? 39?
Yep.
About $39. So one ETH will be now $39. And that means that ETH will continue to fall. So now there's more room for Ethereum to fall more. I mean, for ETH, because Ethereum really looks so bearish if we fall that 1,500. So after 1,500, we have 1,000 to 879, which is $900. It split us on the 9th, 7, 8, Wednesday.
Miss Mary, now who did you say was getting ready to split?
ETH.
Okay.
And Intel's looking pretty good actually. This is my buy-in order in at $19. I would like to do a call again. Josh is doing a leap for INTC, and I think a best way to get it, I just don't want to continue to consolidate here again, just like we did here before, because your options will be eating out your theta. So I really would like to be, if I'm going for an options, I don't do leap. I don't have that much patience to be waiting, but I do like a 3 months, and then I could just get out. But you guys could do leap. You don't have to watch your leap because you just leave it there, and then if it continued to go down, you could just add more. So, but the safest way for me is on this level to enter a call all the way here. But if it's also I mean, for me, I'm not a financial advisor. At this price, it actually looks pretty good. Did they had a news about that rumors again that TSM that they are partnering? Is that correct? Somebody help me with that.
Miss Mary, I have a question. On the leaps, are they doing they're doing a stop loss on the leaps also, or
From my understanding, Josh did not have a stop loss. He actually added when he said something when he hits $20 or $19, he said he'll add more leap. He'll add more contract.
Miss Mary, if it's a 1 year leap, would you keep that call for a year or would you sell it earlier?
It's not necessarily you're keeping it for that year. It's usually when you hit your target price, that's when you get out. And it's normally you don't really hold it for a year. It's just your expiration will be on that year. The goal for that is to have a longer expiration. So your theta is very minimal. And for the stocks for your options to actually have a breather. So there's like so much time for you to accumulate it, and then when this thing start coming up, you'll be making more profit. And let's say your target price is $26 and you bought it at 19 and you have like 100 contracts, or let's say 50 because you've been accumulating it. You could close this lead before the whole year, because this could happen, let's say in 2-3 months or just in a month, because honestly, with the market being so bearish last week, we did not fall so much for INTC. It actually holds pretty good compared to Tesla, compared to SPY. We hold on pretty good for INTC. So this means that this level we anticipating a bounce from this level, and we are very close to these support. We're actually on the support, like literally on the support, just coming down maybe a little bit on the 1881. Maybe that's just the lowest we could possibly be. If not, what will be the next one? Hopefully none, right? Otherwise, we'll be creating a lowest low. Yeah, 1851 is still the lowest. So hopefully we don't create a lowest low and we maintain and respect this level, because multiple times we just been rejecting the support here, 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 here. So if it does fall all the way here, hopefully we expect a rejection.
So So your price target will be around $51, or that target will be way lower? Because
For your expiration,
yeah, within that 1 year leap, where would you target?
$51, that's a lot. I mean, what is Josh expiration for leap? I don't recall. I'm sorry. If I will get to have a call, I will not do because I'm just gonna do like a long call for like a month or two. I will not do $51. Honestly, maybe I'll go to 22. Your premium might be a little bit expensive if you go with 22, but maybe I'll go with the highest, which is around here again with a 26, 24. I think we did an INTC. I did an INTC with Josh, but I did a long call instead of just a leap. Then I just get out when it hit my target. It actually hit more all the way up here when we started right here before. So right now, I think I will go for my expiration. My target price will be maybe under 24 to 27 or $26 for my target price. My strike price, I'm sorry, for my strike price. For the leap, yeah, you could go 36, maybe the highest. But regardless, even if it doesn't hit your strike price, as long as the stocks continue to go up, you will profit.
Miss Mary, I have a question.
Mm-hmm.
Is Intech, is this the leap that he had in the Discord from months ago? Because I was
Yes.
because I didn't see a new one. So is it a good time to get in now if you're not in that one?
If you would like to start, this is a perfect time to get in. I'm not a financial advisor, but this is a perfect time. Why? Because you are on the support level that's been bouncing multiple times. Here, 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 here. So we
Sounds good.
anticipate a bounce from this level.
Thank you.
Yeah. And those people who would like to start a call too, I definitely like this position tomorrow, so I'll watch it. However, if I don't see any kind of rejection candles on this area, I will not enter at all.
Miss Mary, looking at the Weibo, actually it dropped overnight.
How much
Right,
is it now?
it's 1892.
91.
1891? Okay, you're still in my support.
1891 on Robinhood.
How much?
It's 1891.
What did I say with our support? It's all the way to that,
But
to 1851.
it did touch 18.3, then it bounced from there.
Okay, that's a good sign. Let's see tomorrow what it shows us. If not, let's go see what is the lowest we could possibly see. We have two things that we could use.
Yeah, looks like Tesla is already 219.
Okay.
So makes it
Now,
13.
Miss Mary, I did a put with I can't remember if it was Josh or Keenan for a SPY put, and it is up. I did a 560 put.
Nice.
328, and expiration is 620, and it's up $4,000.
Congratulations.
But guess what? I did it on the watch list on Robinhood. I didn't actually take the trade. And I was like, and I had 3 of them that was like that. I was like, oh my God, one was for 816, and all of them were puts, but they were dead on target.
Nice.
Like, okay, my paper trading say it's time to do real trade. And I have done some, but I haven't done any in that amount. I've only done maybe 377. That's the largest amount I've done, but I'm wanting to do some more, but I was like, okay.
That's amazing. So continue practicing it, because trust me, when you deal with your own money, it becomes emotional. So I want you to continue to practice paper trading. And then when you start doing it, you start with a small budget, okay? Not with X amount of money. It seems like you are using a lot of money on your paper trading. So it may not be a little bit realistic when you do it under real money, because you're going to need capital for that. So start small. Start small. However, if you think you could manage it, you have the confidence, go for it. I'm not going to hinder you from succeeding, but I just want you to be prepared that when it comes to dealing with your own money, that's when your emotional kick in harder.
Oh yes, because I think it's emotional now.
Yeah.
Other people Nike. I mean, I've done a couple, but I just haven't done one that large. I have an account to do one, but I just haven't just stepped out there on that just yet. So all of those have just been paper trade, and I was like, because that's why I was asking. I didn't set a stop loss on like on Moo. I do some paper trade, and I didn't set a stop loss. So
Well, what are you
I
supposed to do? You have to learn to have stop loss. Sometimes it's a good thing, but that's how you mitigate your risk.
right.
Mm-hmm.
And I
Okay.
see with the leaps, like with the 3 to 6 months and the year ones is a little different. I do see that I on like maybe when I do just the day ones or a couple of weeks out, when I don't set my stop loss, I don't do as well. But when I set my stop loss, I do a lot better.
See? See
Yeah.
what stop loss could do for you.
Yes.
So what does that mean? It means you have to use stop loss. This is for you. Your strategy works with a stop loss. So implement it, incorporate it, and use it. So don't ignore your stop loss when you're dealing with your own money, okay?
Yes.
Amazing. Okay, so for people who may not know, or sometimes we don't want to draw our support and resistance, right? I've used this since it's 9:34. I have this called pitch fan that helps me, tells me my support and resistance for those people who don't know how to draw their support or resistance, who doesn't want to do it manually. It's like a cheat sheet for me. Use a pitch fan by DGT. I hope you guys could see that. Can you see it? Take a screenshot or whatever.
Yes.
So here, this is how it works. So sometimes, like for example, this one. So sometimes it will not give you the level because it's not going to your favor. Like this particular time frame, in a daily chart, it's only giving you 1966 as the support, but what do you call that? Pre-morning structures is already down to 1881. So if you would like to use that, you're not going to use this because why? You don't see levels coming down. So you have to continue to change your time frame to see where the chart will be beneficial for your level. So on this one, you could use this level for 2 hours and anticipate an 1890, but I don't know what is the level now. So they shows you like the point, the dot shows you what are the support for this trend. So this one is 1890. The second one, usually it's like this level, 1849, 1831, or sometimes it will just give you the dot here that will give you a better number, but just follow this line as well. Like sometimes it will stop here, it will stop here, it will stop here with these dots. It gives you a support and resistance automatically, but use the one that follows the trend. Like this one follows the trend, so use this time frame. And if you're going for scalping, you could use this for a shorter time frame as well. It just gives you a support, so you know where it's going. And usually when the red line, when the candle falls below it, it just serves as more bearish. So, okay. It's helpful. I know some of you guys don't know how to draw support and resistance. This pitch fan will help you at least the levels, so you guys don't panic.
I have a question.
Yes.
Do they have it on Webull or Robinhood
Unfortunately, this is just for Trading View.
Trading View? Okay.
And then if you would like to see a manual, or you would like to use your Fibonacci extension, remember Fibonacci extensions is when we take profits. We want to see how far this thing is going. So this is let me start again. This is a bear territory, a bear trend. So we are going down. So it means you have to use your Fibonacci extension. Starting, your first point will be on the top, and then you point it out at the first pullback on this trend. This is the first pullback. Do you guys agree this is the first pullback going short? And then it leads that down here. So
Yes.
thank you. So using a daily, when we use a Fibonacci extension, see how far it could go. This thing supposedly it's in the 1932, which could actually lead you to $16. This is just a suggestion. How, if you don't know how to draw an uncharted, this is uncharted area, you could just use a Fibonacci extension to see what is the support, or at least how far can it go. If you would like to see more levels, you could just use your settings. There you go, your settings, and you could just click more levels in here. You could add, where is the 4? You could add 4, you could add 3.2 to see more levels right here. And settings. I don't know, where are you? 2, you could see 2.4, 0.2, and you show you more levels right there. Okay. Do you guys have questions before we?
What's the name of that again? That feature?
This one is called Fibonacci extension.
Oh, sorry, the previous one that shows supports and resistance.
The previous one is a pitch fan. Hold on, let me just delete this. This one is more easier to use because it gives you the, instead of you pointing it out, this is already plotted for you. This is the pitch fan by DGT.
And another question I had is, like we see, like for example, Weibo is showing what the prices are at night, but is there a way we can buy it like right now, or do we have to wait until
It
March?
depends on your platform if it allows you.
Okay.
But you just have to make sure you when you buy it, it has to be a limit order because you cannot do a market price for that. So you have to put it as a buy-in order as a limit order, and then you have to use extended hours for it to get triggered. If you put
Right.
So those things you just have to modify your buy-in orders.
Does anyone in the group know which platform that allows you to trade like right now?
Who has Robinhood or
Robinhood and Webull probably do. Webull has the 24-hour market, so
there you go.
overnight market. So that means it is available for you to buy it and or sell it.
Oh, okay.
Yeah.
Thank you.
Mary, I dropped a link in the chat about, there's a short video on how to use Pitch Fan on TradingView on YouTube.
Thank you so much. Thank you, Tom. This is being recorded, so you guys could be able to see the YouTube that Tom had sent. Or please, Tom, can you put it on our chat, please?
On Discord?
Yes, please.
Yep, I can do that.
Or you could put it in the class questions.
Got it.
Yeah, so to those people who would like to learn about the pitch fan, here it is. Yes, this class will be reposted. It's actually being recorded right now. So once it is completed, we'll put it in our little class.
To pass IT certification exams easily.
Any more questions?
And updated exam questions and answers for.
Thank you so much.
To begin using the Pitch Fan tool in TradingView.
How many minutes is that pitch fan?
I did the same thing, Dennis.
How many minutes is the pitch fan?
2 minutes.
Okay,
Yeah,
let's go ahead and study it. Somebody would like to share their screen, so I don't have to do it. I'm gonna stop sharing. Somebody share. Tom, would you like to do the honor?
Yeah, give me a second.
Thank you, Tom. So we have 2 minutes. So before we go, let's go ahead and watch it.
Oh,
Good using the Pitch tool within the charting interface. You can find it in the tools. Scan and
Wait,
Fibonacci
is it
show.
showing up, Mary?
Once selected, you will need to add key points on your chart, the starting and the second pivot point. These points are
Oh, I think I lost Zoom.
We can see it.
Oh, okay. I'm sorry. You guys can see it? Okay.
Yes.
Yes.
I'm sorry.
foundation of the pitch fan.
I think it's breaking out, Tom.
Finally, as you these lines
Tom, I think it's lagging.
Is it? You want to stop it? Was it not coming through right?
Is it coming through, guys, to you guys? I guess it's mine. It's lagging.
The sound
sound is
is
off.
breaking up and no sound sometimes. But
Visual
whatever
is fine.
he's doing, we can see it.
No
It's almost
audio.
fine. You want me to just, yeah, I don't know what, I mean, I got audio up max, I don't know.
The visual is fine.
The visual is
Okay.
fine. We could definitely
Oh, and
follow it all.
it's closed caption too, so. All right, I'll just finish it out. It's got 45 seconds left.
Please.
potential. Individual trading strategies. You can adjust practice.
Okay.
Thank you, Tom. But I think the one that I give you guys, that you don't have to manually know how to use pitch fan. It will do it for you automatically. So that is how to use pitch fan on your own. But the what do you call that? The indicators that I gave you guys does it for you automatically. So that will be a lot easier. It's just you have to make sure that the pitch fan that you are using is going towards the candle that it will show you the level. If it goes the opposite, it means you have to change your time frame to the one that gives specific levels where the chart is going or where the candle is going. Okay, we'll talk more about the Fibonacci once we finish with the class with options. We'll talk to Tom when he's going to be available, and then we'll go over covered calls again. Maybe one Sunday covered calls, Tom, and then we'll do the selling puts the next time that you're available. Will that be fine?
Yes, ma'am.
All right, then we'll talk to Tom when he's available, and then we'll keep you guys posted. If Tom is not available next week, we'll go ahead and review those support and resistance because I think those are very important for us to master. We have to master our technicals before we actually jump into another options or another trade setup that we don't even know how to read the technicals. I think your foundation first is to learn your technicals, and then as you move in, as you gain all this knowledge, we could trade more to a complex trade, like options and covered calls and selling puts. That's it, Tom. Thank you so much, Tom, for giving your time. We
Pleasure.
appreciate you being here, and thanks everyone who's here. We'll see you guys on Monday. We'll see you tomorrow, and we'll keep you updated next week what we're going to do for Sunday. Either we'll continue with Tom or we'll go ahead and do a review with the technicals. And then we could record it so you guys could go over and revisit that class over and over again using our YouTube channel, okay?
So, Miss Mary, next week you go over the morning structure and pre-morning structure again?
Yes, we could go over it again. You know what? Tom, I know you gotta go. I saw you yawning. Let me go ahead and before I go, I promise everybody the morning structures. I think without morning structures, the class is not complete. So let's go ahead and learn the morning structures of Josh. Let's go with Tesla. Real
And
quick.
I'm gonna jump, Mary. Thank you, everybody.
Absolutely, Tom. I really appreciate you. Thank
Thank
you,
you, Tom.
Tom. Thank
Hey,
you,
Tom,
Tom.
thanks.
Thank you, Tom.
Thank you, Tom.
Okay, let's go ahead and do the morning structures for Josh. What do we use when we're using morning structures? 5 minutes.
5 minutes.
5 minutes using what? What's the first structure that we have to use? Morning or pre-morning?
Pre-morning.
Pre-morning, that's correct. And we need to use what? Extended hours, right?
Yes.
Extended hours for TradingView or Robinhood. Make sure you guys have an extended hours, otherwise you will not be able to do a setup for your pre-morning structures. So for scalping or momentum trade, we are going to use the 5-minute chart. The first thing we have to identify is the highest high during the pre-morning structure. We are only going to use the body of the candle, right? Do you guys all agree?
Yes.
Okay. The body of the candle, do you guys agree that this is the top of the body of the candle during pre-morning structures for Tesla?
Yes.
Yes.
Okay. What is the second one that we have to draw?
The lowest low.
The lowest low using what?
The body of the candles.
Can you guys draw that? Where is it? You guys agree it's right here.
Yes.
Okay. So I normally use the yellow, meaning it's the pre-morning structures. So we have the pre-morning structures resistance and we have the pre-morning structure support, right? So
Yes.
now we are going to use VWAP session. Nothing special with the VWAP. This is just a default. You are more than welcome to use the bands, upper bands, lower bands, to fill in the bands. It's all up to you. However, it becomes a little bit clutter, right? So to minimize those clutter, to clean our chart, we would like to make it clean and cut and no clutter. So we take it off. So that's the VWAP. The second one is we wait 15 minutes. And that 15 minutes in the 5-minute chart, how many candles is that?
3.
3. So whatever we did during the pre-morning structures, we are going to do the same thing with the morning structure. So 1, 2, 3, we wait for 3 candles on the 5-minute, representing 15 minutes. That will be 9:45. You get to identify your higher high of that 15 minutes, and you're also going to identify your lower low. And again, we are going to use what? The body or the wick?
The body.
The body. Thank you so much for responding. So I normally put green to represent morning structure. So now we have the morning structures and we have the pre-morning structures. So now what are we missing? After we incorporate all this trend lines for the support and resistance, morning structures, we got VWAP. The last thing we have to take a look at is what?
RSI.
The VWAP. We're going to use the VWAP. Take a look at, I'm sorry, not the VWAP.
MACD, the 1 hour MACD.
That's correct. The 1 hour MACD, I apologize. Thank you. It was 1 hour MACD. And if we are going for a put, what do we would like to see? We would like to see a MACD line pointing what?
Down.
Down. If we're going for a call, we would like to see MACD curling
Up.
up. Exactly. So pretend this is we are live trading right now and this is pointing down and it is pointing down. So we are confirming for a put, right?
Yes.
Okay. A lot of people say, Mary, I don't understand Josh setup because it doesn't seems like when I trade with him, he go against his trade setup. Please, Josh is an expert. He knows when to get in, when to get out. He read the chart. He knows the market. So if you're a beginners, I highly suggest you guys draw your morning structure just like this, just like what Josh has been teaching you guys. You stick to the plan. Let's stick to the plan. Don't worry what other people are doing. Don't worry about just because one person is making money and you're losing money and this and that. I want you to worry about yourself. Okay, use your own strategy. Use this strategy. So what is the technique? Wait for three candles. 1, 2, 3. 9:45, it's now 9:46. So we are respecting this morning structures. It went up and bounced up. Guess what? The good thing about VWAP line is we're going for a put, right? The confirmation of a trade is always the back testing. Normally, when we back test a VWAP, let's say we are continuing to go down and we back test this VWAP, and it gives us lots of wicks, it means it's a rejection, right? And this is the opportunity for those aggressive trader, an opportunity for them to get in. Guess why? Why is that, Mary? Because this long wicks, as a matter of fact, this VWAP is serving as a dynamic resistance. Dynamic resistance means the level could change. When the time goes by during the market session, it could change. It could either go down or go up, but it serves as a resistance level. So you have actually two long wicks here. We could say that this is 220, 254, 253.88. We could say, Mary, we had a tweezer top in here. We have two long candles in here, rejecting this resistance, the VWAP, which is a good sign to confirm a put. So when do you enter? Having all these greens is a little bit scary, but giving you a confirmation of this long wick means it means that we are rejecting the VWAP. So what is the best options? It's either you're going to wait for the red candle to enter, as long as you are trading below the VWAP. This is for aggressive trader, okay? For those people who are not an aggressive trader and beginners, what do we want to confirm? We want 3 confirmations. We would like to be below the resistance of the morning structures. We would like to be below the morning structures, the resistance. We would like to be below the pre-morning support. Guess what? Where do you enter? It's a bit scary if we wait either here. Confirmation is this one, this candle, to go down. So your entry for beginners is below here. No, just please that. So those people who are entering those confirmation, we would like to be below VWAP, below structures, morning structures, and pre-morning. Your confirmation is right here. When the body of the candle falls below those 3 resistance or morning structures and pre-morning structures, this is a confirmation, less of a risk for those beginners to enter. Aggressive starts here, beginner starts here. Yes, those people who are aggressive because they know when to exit and when to enter, they have more experience, they could make more profit. Don't worry about them. Worry about yourself because your purpose is to mitigate your risk, but at least make profit. And if you do follow that instruction that I teach you guys and Josh teaching you, you make money right here. A simple instruction. A simple instruction. You already make money for Tesla.
Okay, so Miss Mary, now that makes a little bit more sense because I see where it's saying like for it's set up for, I think for Friday, and how it talked about the breakdown. The aggressive is below 190, target is 189.10 to 187. But I do see they got down errors, so I guess I'm assuming those are puts.
That's correct.
Oh,
so
okay.
if you see the numbers going down, that means those are puts. If you see the numbers going up from Josh, it means that's a call. When he say aggressive, it's normally those people who have experience and kind of know, the charting more. And those who are, let's say, traditional or less of a risk is for beginners. It means those had a confirmation that the trade will definitely go to your favor. So less of a risk.
Okay, because he's got aggressive, and he has a target, and then he has conservative. So, okay.
Okay, the aggressive is those people who have more knowledge or have a high level of tolerance, you know, and the traditional or conventional is the one that's it's already less of a risk and possibility of making profit.
Oh,
I'm sorry. Okay. Any questions? No more questions. All right. So
Okay, I do. I have one question. I know I'm looking here at it. So when he give us those levels, we can go and choose our own strike price. Is that correct?
That's correct. Remember, we
Okay.
talked about options last week, right? What do
Right.
we say about strike price and expiration date? It all depends on your budget, right? And all
Correct.
depends how long are you willing to hold these options. So if you're scalping, would you like to, because if you're scalping, you are going in and out of the trade the same day, right? So it
Correct.
doesn't matter if your expiration is this Friday or you want to do it for next week. So that means either your premium might be a little bit higher if you extend it another week compared to a shorter expiration date. It's more cheaper if you're scalping. You're cheaper if you have a shorter expiration date. So it
Right.
all depends on your premium. It all depends on your budget. It all depends on how long are you willing to hold this trade. Are you holding it overnight? Remember the rules of thumb per Josh is 1 night is 1 week, right? And 2 days is 2 weeks. And you also look at your delta and what is the difference of the delta between expiration of this week to a next week. There's a big difference. Sometimes 10, 20, 30. It all depends. The delta is how much profit you're going to gain for every dollar the stock goes to your favor. Or
The higher the delta, the more, or what's the
higher the
calculation?
delta, the higher the premium.
Okay.
So that's why I said stick to your budget. If you have $600, you could only afford $600, and then you could pick which premium is more affordable for you. Okay.
There are a few questions, Mary.
Okay.
One of them is how much do you pay for Trading View? Oh, somebody answered it. Never mind.
Okay.
Through texting. And how many stock is safe to trade at a time? Caroline asked.
Okay. So you don't want to do over trading, right? Majority of times, 3 trades per day will be better. Actually, over that, it's sometimes a little bit overwhelming. If you are familiar or have experience trading, maybe 2 options at the same time, but that's really hard. For me, I don't. If you're scalping, I think focus on 1 options per trade and then move on to the next one. Not unless you have automatic stop loss and take in profit set up, then go ahead and do it. But if you're manually watching these stocks, these options, I suggest 1 trade at a time, maximum of 3. Otherwise, you'll be calling yourself a over trading, which could be overwhelming, especially if you're losing. And then also, if you're winning, now you're high confident, and then you're gonna go over trade, and sometimes that's when we lose because we over trade. We have that high confidence that yes, we're gonna win, and then we start losing. That's when we lose control of ourselves, and that's when we lose money. So at least set a strategy of maximum of 3 trades, have a stop loss. I'm willing to lose $100 today. My goal is to have $100 profit too at the same time. So it's either 1-to-1 or 1-to-2. That's all up to you. It's subjective. In regards to a trading view, I think Ertuan, we discussed this trading view specials. It always good to buy during Black Friday because you get 75% off pretty much, or 50% off if you pay the whole year subscriptions. I got mine during Black Friday, and I think it was 75 or 50% off for the whole year. So the only thing is you just have to buy the whole year. Or you could do a month to month. I think it's like $30. Is it $30 or something like that per month? Okay,
And Lawrence asks, What do you do? What do you look at before exiting a trade?
Candles, rejection candles. What are rejection candles? Wicks on the bottom. If you're going for a put, one green candle, you're not unless you are in profit, you could either get out. But one green candle serves as a healthy pullback. Two green. Third green is a little bit scary. It may either reject that support and then pull back and go up and retest either the morning structures, the pre-morning structures, or the VWAP. So those are the little hints. It's always the long wick is a bit scary because it serves as a rejection. But one candle of a, let's say if you're going for a put, one green candle should not scare you. Okay, because it could just be a healthy, you see this? This is a good example. There you go. So one green candle, yes, we have a doji in here. One green candle is a pullback and then continue again red. Another green candle is just a pullback, then serves again. However, if you have three, that's why I said 1, 2, 3, you see that? We're either retesting the morning structures, which is the pre-morning structures, and retesting the VWAP. So if you enter here, all this profit will be gone. You will be losing. So this is called momentum trade. When you see one green candle, you hold it. Another red, which is, this is a really pretty candle. I think you should really get out. And then you have this second candle, you'll lose a lot of money here with this big green elephant candle. And then some people will hold it because they think, but if you have this big green candle, you have this bullish engulfing candle, I think that's really a sign to like, hey, get out because we may retest this VWAP. It's normally, they normally always retest the VWAP. Yeah. And here comes your 9 EMA to that person who asked. My 9 EMA is the white one. Here's the 9 EMA. So the 9 EMA serves as a cushion for you when to get out early. So using your 9 EMA, if you see one candle that breaks above the candle, like this one, you see it close above, or this is a breaking candle. Maybe this one right here is the confirmation, but this is already a confirmation. With this candle, breaking above your 9 EMA serves as a stop loss for you. But with that one, I'll be looking at the third candle because it's only like, what time is that? 10:50. You could either start looking at the 10 minutes actually for that. If it's like 10:50, volatility already subside. So start looking at the 10 and 15 minutes, okay? 10 and 15 minutes will give you a bigger picture of the market because it's a longer time frame compared to a 5-minute. So, but that 10 minutes, this green candle is just 2 candle. It just continued to fall below the VWAP. But we're going to just continue to consolidate, go up and down.
Yeah, the Tesla, I feel like it's very tricky because sometimes, like over there on that chart, I was hitting the VWAP and bounced off, but you had already made that U like shape where it could have broke out of the VWAP and continue higher, but it didn't. But if you exited early,
You
thinking
make money.
like you're losing and then you're losing on your put, and then it turns around and it comes back down. It's kind of crazy. I don't know. It's hard to chase.
When this consolidate, let me get the wrong one. I picked the wrong one. When you see red, green, red, green, red, green, that means consolidating. Guess what? Your options are losing. When you're consolidating like this, there's no exact pattern.
Yeah.
This is how we make money. This is how we lose money. This is how we lose money too. Why? Because it doesn't give you a clear path. It's just consolidating. This will give you money a little bit, but you have this red, red, green, I mean, green, green, red, red. It's just colorful. It doesn't make you money. Right here gives you money because it's all one momentum to the downside, all red. Going up is not giving you money. Every time you see red, green, that's those Christmas lights. you are not making money. You are consolidating. That's why Tesla is very hard to trade.
Yeah, I really like on Friday, really thought it was gonna go up, but end up going down. So I kind of got out with some loss because I had taken a call, and then all of a sudden just plummeted.
Yeah. With that, you could prevent that by either setting your stop loss or look at your larger time frame. If you're in the 5 minute, start looking at the 10 minute and 15 minutes. Sometimes just peek on the 1 hour or 30 minutes, it will definitely give you a bigger picture of the market. So you see Josh taking a look at the 10 or the 15 minutes. Oh, let me go take a look at the 15 minutes. What is this candle going to end up with? If this is just a red candle, I'll stay. If it's just a green, then I'll get out, remember? And sometimes he shows you, oh, we have like 3 minutes to finish this candle. It's right here. Like right now, you cannot see it because we're not live trading, but normally it tells you right here. It tells you how many minutes this candle will be completed right here. Like, okay.
So are we saying that it's much better to gauge higher time frames to see where we're going versus going lower
Well, if
to
you're just
anticipate the ending?
No. There's a purpose using a shorter time frame sometimes. Some people actually just use like Ertuan, he likes to use 1 minute, 2 minutes. If it's too early, you could look at, let's say like, volatility usually happens within that 15 minutes. Actually, for me, it's 30 minutes. Within that minutes, I always look at the 3 minutes and the 2 minutes, but normally it's the 3 minutes for me to see where is this going. And then if I see like, okay, we are sometimes when around like 10 o'clock, 10:30, you could definitely see where the trend is going now. That's when you could start looking at your 10 minutes to 15 minutes or the 30 minutes. I don't think it's advisable. Well, for me, I will not look at the shorter time frame if it's already past, the volatility is already down and we could definitely see where the trend is going. It's better off to take a look at the bigger time frame on that.
Yeah, no, I was talking about in terms of being aggressive in terms of your entry. Like after you've
Aggressive,
laid out
shorter,
after you've laid out your levels,
shorter.
Okay, okay.
Aggressive is always shorter time frame.
Perfect.
Using a 3 minutes to 2 minutes. 1 minute is too early. 3 and 2 minutes. If you want to be an aggressive trader, you want to do an early entry. 3 minutes. Okay.
Miss Mary, I have a question.
Sure.
The other day I did a straddle option on a SoFi, and for both of the call was $30 and the put was $30 for the same strike, and I made $200 for it for the put. Is it possible, or do you think that was a fluke, or do you think that is a possibility that would work like every night if I chose to do that, if I held overnight straddle option?
Honestly, I used to buy options right before the market closed and I'll exit out right away and it works out for me. That was doing when I have confidence on myself for that particular stocks. I will do that. Sometimes I do that. The only thing is right now with the market sentiments, I'm not quite sure if I will do that technique to hold it the next day and sell it in the morning, just because it's too volatile for me. Sometimes it works, sometimes it doesn't. You just have to know your stocks. If you know that stocks, if that's what you've been doing and continue doing it, and if it works, go for it. Sometimes it works, sometimes it doesn't, but you just have to make sure you're willing to lose that money.
Okay.
If you been familiar with the stocks and that's what you've been doing and it's been working for you?
That was the first time I've done it.
Okay. So try it again, but I hope you're using your technicals, right? That's how I did it. I used my technicals before I get in and hold it the next day, and it was pretty good for me.
Well, I did the straddle option where you buy the call and a put. So either way, it's kind of go one one way or the other.
Mm-hmm. The only thing with that is you're technically gambling. You're just, because you don't really know. I mean, the other one, the other one doesn't go to your favor, you expect the other one will go to your favor, right? So
Yeah.
you just have to make sure how much you're really losing. If you're okay, like, are you willing to lose one premium? Let's say it's $100 and $100. So you're gonna lose the $100 for sure, and this $100 gonna make profit. So as long as you're okay with that, just make sure you know your risk tolerance.
Okay.
Just don't buy premiums that's so expensive and you do straddle, because if the other one is 500, the other one is 5, so that's $1,000, right? So one of your put or call will go up and one will be going down to either 50 or 100% out. But just know your difference.
Okay.
But just be careful, please. If that been working for you, go for it. But if this is your first time, you could be lucky or maybe not.
Yeah, that's what I was wondering.
Yeah.
Okay.
Okay.
Thank you for answering my question.
Of course, of course. What level do I have for trading view? I think I'm allowed to have, I don't know how many, I don't remember. I think I have 30 or indicators. You guys don't have to have multiple indicators. Just use like even 5, or you don't use all those indicators at the same time.
There are like 3 levels this mirror. That's what I was asking.
Oh, okay. So I think I got the
They
last
got the
level.
basic, and then they got premium.
Yeah, I got the last level where I could use a lot of indicators. Let's see, I have 13 here. So I could add more.
So you have premium.
Yeah, yes, I guess. So because I think the second level is only 10, right? 10 indicators.
I'm not sure.
But regardless, you guys don't need a lot of indicators. I just use these indicators just to teach you guys, so I don't have to keep, checking. You want to have a clean chart. You don't want to have too clutter of a chart. See, I don't pull out my EMA right away because I would like to see where my market structure is going. Okay, and guess what? Airtwan doesn't have a subscription before, and he's still making money.
Yeah, one of them has 5 indicators, one has 10, and the other has 25.
Okay, so I have the 25.
Okay.
But you guys don't have to have 25 indicators, just like I said. You could just have 5 or 10, because you don't use all those indicators. The most important thing is just learn your technical support and resistance, when to take profit, have strategies, basic.
You're generally only going to have 3 or 4 indicators. So your RSI is one of them. MACD will be another one.
Yep.
And then whatever you need up on the charts for your EMAs or.
That's correct. Mm-hmm.
So technically you need 3 or 4 at a time.
Yeah. All right, everyone. I think this is it. Good night. Thank you guys for being here today with us. We'll be teaching, either Tom will be teaching again, or I could be able to do reviews for you guys before we jump into the next level. But I would like to elaborate more on the covered calls. It sounds like some people didn't get it yet, which is I totally understand. And then we move on to selling puts. We'll move on to the spread that he's saying. So we'll do baby steps. Will that be better for you guys instead of jumping?
Yes, Miss Mary. This was my first French class.
Okay. Oh, well, welcome. So let's go ahead
No,
and
I'm saying I didn't understand very much. It was my first French class.
no worries.
It was most French to me.
Oh, okay, don't worry. We'll clarify everything as much as we can. We'll make it as simple as possible. I'm gonna work with Tom and we'll talk this week and we'll set up an appointment. If not, we'll go ahead and do reviews next week.
Review, yeah.
Miss Mary, can I make a suggestion or a question really quick? So when you talk to Tom or when you do training, can we do like a swing trade section? Let's say buy like a 5 Tesla or a TSLL, then hold it for a week. The entry and exit, how much profit we could take. Even with the Tom, when you talk to him, if we could, do a call option that way, it would be very helpful for us.
Honestly, are you in the Discord?
Yes, I am.
Do you see Airtwan's trade?
Yes.
We do swing trade in there. Like I think one of them is our swing trade is TSLL last week, and I gave you guys a take-in profit. I specifically said that $12 will be our take-in profit.
Oh, I
And
missed that. Sorry.
you missed that? Don't worry. Let me show it to you guys. This Discord, when Airtwan does his trade, what we do is we use Airtwan's trade only. So that's why we said, please don't send any comments in here because only Airtwan and I'll do a TA for Airtwan's buy-in orders. So we did a Tesla TSLL last week, and that was when we actually, what is our buy-in order? Some of us got stop out, some of them hold on to theirs. I did not get stop out. I hold on to mine and I sell it at I think Airtwan sold it a little bit early, but he keeps buying and he keeps scalping fast. Where is that TSLL? So TSLL, he bought shares as 100. We said yesterday we analyzed SL, noted that the chart had broken out the descending channel, the top resistance. When we say resistance, that is our buy-in order, right? I mean, our take profit, excuse me. So today we form an inside bar, remain 892. We open above $12. That means it will go for bullish. But guess what? Tesla did not go above $12. It won't even break that. Now we are breaking down to, I think it was 769 on Friday or Thursday. I don't know how much is it now. So his buy-in order is given with a technical analysis, guys. So like here, he said he bought it at 38. And I also give you guys a stop loss. And I give you guys a resistance. When I give the resistance, you could pick your level when to take profit. So all Airtwan's trades are swings.
I stayed in on those trades. I'm losing a lot.
On
I didn't get
Airtwan's
out.
trade?
Yeah, I didn't get out. I got in late on the TSLL.
You did not get my text, my email? I mean, not my email, but my.
Yeah, I missed it.
Hmm.
I'm still in the TSLL.
That's okay because it's Tesla. I know you're gonna lose. You're gonna be a bag holder on this one, but this is Tesla. Tesla is a lucrative company. It's a good company. We're just facing problems fundamentally. So
Yeah.
just hold on to it now. You really have no choice either to sell it for.
Yeah, I have 3 of them that I'm holding.
Yeah. I did send message. I don't did you guys see my message about when Airtwan sold his profit? I said to those
Yeah, I
people
saw
who
when he
has
sold it, but I got in so high
okay.
that I couldn't sell.
Oh, sorry about that, King. Yeah, I did give a message when Ertuan sold his a little bit early. I said to those people who hasn't sold it, these are the level to watch. You've been taking profit. And then when I hit that $12, I also said that $12 is our top resistance. So that was the highest that we could possibly sell it because we're just swinging it. And if we see Tesla go above it, but it did not give us a no higher high. So I was expecting people will listen to them, will read my text message.
Yeah, still holding HOOD, still holding MSTX.
Yeah, MSTX, you're holding MSTX too?
Yeah.
Yeah, you're losing money right now too, but it's okay. I think everybody's losing money with this market right now.
Yeah.
Well, how much is MSTX now?
It says 22.
Okay, so we are not out of the woods with MSTX. We have $20 to 1940 all the way to 1790. So if we are in 22, so 2345, 2133 is your support, but it might test all the way here. So you really gotta have to hold it.
Yeah.
Mm-hmm. All right. I think this is the third time I'm saying goodbye, but this time this is really goodbye.
Miss Mary.
All right,
Okay.
Miss Mary. Good night. Thanks.
All
All
right.
right,
Good night,
guys.
Miss
Have a
Mary.
great night. We'll talk
Miss
to
Good
you.
night,
Mary.
Miss Mary. Thank you
Thank
so
you.
much.
Bye. Thank you.
Good
Night.
night.
Bye-bye.
All right, thank you.
You're welcome.